You don't owe me anything for any of it. It's what we do to help you be better. So come to me, ask me questions. I'm happy to help you navigate the programs. But our website has all the programs I just talked about on it and links on how to get more information. And the only other thing I want to mention is that for all of the SBIR awardees in the room, you have to understand that once you have an award with one agency, you are eligible to bring that award to another agency as a phase 2 project, whether or not you got a phase 2 award with the original agency. Those are called cross-agency awards, and it's an authority that every SBIR program has. All 11 federal programs can do that. It's no magic. What's hard about this is that each of us call it something different. At Air Force, it's their Stratfi and TACFI program. At Navy, it's Catapult. At Army, it's Catalyst. It's all the same authority. So don't let our terms get you wrapped around the axle in trying to understand it. If you have an award at one agency, you can have another award at a second agency. That's a cross-agency award. And at Navy, I'm issuing a solicitation on October 2nd to help leverage those awards in a solicitation-based process. Normally at Navy, it happens organically. You find a Navy customer, that Navy customer advocates for you and submits a nomination for a second phase 2. Trying something a little different, we're going to issue a solicitation that has 4 topics that SecNav gave us. So these are really high-level, big, cross-component topics that SecNav wants help on, and he wants to leverage the SBIR program for that help. So that solicitation is coming out October 2nd. You can find it on our website, and all the qualifications or eligibility requirements will be in the solicitation. But all you really need to know is that you have to have had an SBIR award somewhere, at least a phase 1, and you have to have at least one or your second phase 2 available in that topic area for us to leverage. So come look at our website October 2nd. I'm happy to talk to you about the process and the solicitation this evening. I'll be at the mixer. And again, thank you all for being here, and I'm looking forward to an exciting afternoon. Thanks.
Thank you, Brian. And so quick housekeeping before we actually start the event. For those of you that are in person here, bathrooms, restrooms are just down the hall here to the left. So at any time, if you need to take a quick bathroom break, feel free to just pop out back to go to the restrooms just down the hall to the left, first left, and you'll see a little sign. We do want to make sure that all the sessions here are interactive, so we highly, highly encourage y'all to interact with us. Anushka will be seeing some really great things. We want to hear all of your perspectives. Really, learning happens through discussion, so same to the folks that are online. I will be your in-person advocate for those virtual attendees, so feel free to pop questions into the Q&A, and we'll get them answered for you as well. And over to Stephen to talk through our agenda.
Thank you, Donna. My name is Stephen Youssef. I serve as a senior commercialization lead with BM&T Ventures. BM&T Ventures is hosting this event in partnership with the Department of the Navy. Brian, thank you for all that you do for the companies that are in the Navy SBIR program. We're very excited to kind of share with you the agenda for today. It'll focus on exit strategies, how you can position your company for the best exit possible. We'll be talking about exit strategy from a founder's perspective. A dear friend of mine, Dr. Jamie Tenedorio, 9 Exits is going to be giving thoughts after Anushka's presentation. We'll be also talking about it from an investor's and a corporate strategic investment partner's perspective with Chris Moran at Lockheed Martin and Steve Weinstein at America's Frontier Fund. To start, and then following that, I'll be hosting a fireside chat with BM&T CEO Pete Newell, as well as Steve Weinstein from America's Frontier Fund, talking about business model generation, hypothesis testing, and validation. The reason why we wanted to talk about that on a day that focuses on exit strategies is because you can't have a successful exit if you don't build your company right. So we'll be going through and talking about how you can build your company from a startup, all the unknowns and uncertainties about the market, the product, the fit, into how to build it so that you can get a good exit. Following that, We have 3 companies that BMNT Ventures is advising and coaching: Qswami, Otis Aviation, Transient Plasma Systems, 3 high-flying venture-backed or venture-track startups that will be pitching to the investors that are in the room. Following that, we have a founder investor panel, and then finally a networking and happy hour that you all are invited to at the BMNT office, just a minute down the road walk. So with that, I'll be giving it up for my good colleague Anushka Prasad. Anushka is a strategic advisor for BMNT Ventures and the host of today's Exit Strategies Workshop. Thank you, Anushka.
Thank you, Stephen. Great to see you all. Very excited to provide this workshop. If you haven't been to one of our prior workshops, really the Navy Private Capital Bootcamp is a series. We started with, really starting with what is private capital, what is venture funding, what is angel investing, and we've moved through that, through the 3 bootcamps that we've done to now, which is our last one for this session, to exit strategies. And really the goal is I will be providing very foundational knowledge because, there's lots of different people with lots of different experiences in the room, and we want to make sure that we're giving everyone the foundation. And then to make sure that you get the nuances and insights, et cetera, we have founders, investors who will be joining us here to answer your sort of specific questions and through their, actual experiences going through exits. So the hope is that will give you a well-rounded foundation and insights from people's actual lived experiences. One other thing is, so I'm trying to make this as interactive because I have historically found a lot of lectures kind of dry. So we have worksheets for you that we will be handing out right now that, feel free to take a look at them. They're for you to fill out and take notes on as we go through the bootcamp. It's really to help guide you in thinking about how you want to think about your exit strategy. You can do this today while we're doing the session. You can take this back with you. And we have office hours. So let me just skip slides. So we have office hours. And if you fill out the worksheet and you find that you have questions that you want to continue asking, we are happy to take some time and answer those questions for you and make sure we have the right people in the room to do that. So I think some folks just entered, so we'll just give them a second to settle down. And I will be making this slightly interactive. So I will be asking you questions, and hopefully everyone is okay with that. And we'd love to see hands up, giving your perspective. And if nobody raises their hand, I don't want to be a business school professor, but might have to call on someone. So, all right, okay. Are we ready to go, Sardar? Okay, all right, let's do this. So, really quickly walking you through today's agenda, we're going to start with the basics of exits. Why are they important? Why do we do them? Why do they exist? We're going to talk about stakeholders because exits impact a lot of different people. If you're running a company has so many people involved in it. We want to make sure you understand who are the stakeholders, how do they get impacted, and what do they care about when you're going through an exit. We will focus on mergers and acquisitions for today because, to be fair, 90% of exits are actually M&As and not IPOs. And they're probably the most relevant to you as a startup founder or a small business founder. And so we want to focus on that. We will then cover IPOs. IPOs have a lot of regulatory requirements and governance. And so there's a lot of information there. So we will cover it briefly. And then this deck will be sent out to you after for you to review on your own time if you want to go into it more deeply. And then lastly, we'll just cover common challenges that people face, right? These are difficult processes and it involves a lot of people. A lot of people have, differing incentives. And so we want to make sure that the common challenges that can happen during this process. All right, let us get started. So actually, just to start off, I wanted to ask you, why do you think that exits are important for, the founder and investor ecosystem? Sure, amazing, yes. Yeah. Okay, so for the online folks, why do we think exits are critical for investors and founders, essentially? Oh, okay, sorry, your answer. Sorry, could you say that again? I'm supposed to repeat it back. Sure, yeah. Yep. Anybody else? Yeah, okay, yeah, basic, yep. Okay, sure, yeah, definitely. Go for it. Okay, yep. Yeah, definitely. All right, okay, I'm gonna jump into, again, so we're starting really foundational. Fundamentally, this is one of the big points in an ecosystem, right? You need an exit to incentivize capital to come into an innovation ecosystem because it's the only way that, when capital comes in, you create something with more value than what was previously provided and allow sort of growth to happen from that perspective. So exits are critical. It's what lets money flow to the beginning of your idea to help you get to the end of this process where many people benefit. And the reason I'm focusing on this is because sometimes this can seem abstract or disconnected from the function that it plays in our society or in our economy, but it's really critical. It's the reason that the US is such a big innovation economy in the world is because we have historically had really good exits and IPO markets and mergers and acquisitions. And one of the things that we will talk about later with the panel is, what happens when those market conditions change? What happens when we don't have a regulatory environment that is as friendly to IPOs or M&As? It can impact the top of the funnel. It can impact the beginning of the innovation if the end has suffered. And so really starting with the end in mind almost. Again, we've discussed this. I'm going to keep this brief. We're covering the main types of exits. Today, we'll focus on IPOs, which is the process by which a private company offers its shares to the public, usually gaining a large amount of capital and at a high valuation. You have acquisitions or mergers, which is when two companies merge or when one larger company acquires a smaller company. Usually, the capital doesn't necessarily come in for the smaller company's growth. It just it gets merged into the larger company. And then another way of, founders and shareholders receiving an exit, a little bit earlier in their small business or startup journey is secondaries. And secondaries are essentially when existing shareholders, they sell their shares to potentially new investors rather than through a public market or an IPO or through M&A. And essentially, it doesn't change the operations of the company. It just helps investors or founders gain liquidity earlier. And so that's another way of incentivizing folks, or if somebody needs liquidity sooner, that's one way of doing it as well. There are two more that we will not talk about today because I don't know if we don't want to cover them today because we don't believe they're as relevant. But we have buyouts, which is when a private equity firm buys your company out or when your management buys your company out. And then liquidation, which we don't want to talk about because hopefully nobody has to go through that. And everybody gets to where they want to get to a successful exit. So we will move on from this one. Okay, so my next question for you guys is, who do you think in an exit process are your main stakeholders and what do you think they care about? Someone's got to bite again. Oh, amazing. Okay. I wish I could hand the mic around, but I don't know if I can do that. I can hand one. I can just give mine maybe. Okay, let me run to the back so that the folks online can hear you.
Oh, I was going to make a smart-ass comment of the lawyers are clearly one of the key stakeholders. They care about their transaction, deal pieces. But I mean, I think the founders and the acquirers, right, are the two biggest maybe stakeholders.
Anybody else?
investors obviously want to get their money back so they can recycle it and make more money. And your employees care about it because, one, they may have ownership, should have ownership. And number two, it helps actually grow the company, one assumes, if it's a friendly exit.
So there was somebody online, you said?
We have from online, sorry if I butcher your name, Andrea Somer says founders, customers, employees, and investors. Thanks for answering online.
Thank you. Last go. There's many. I see a hand up back there, so I'm going to run back. Okay. Yes. Okay. Yeah. Customers is definitely one. You'll be surprised at how many.
If you're a VC fund, definitely your LPs, your investors, major stakeholders, and they're expecting a return on their investment.
Yep, definitely. All right, okay. So we've covered quite a few, but there are still more. And I have a little chart that tries to give you a sense of, how many folks are involved in this. And actually, this doesn't include a few that I couldn't fit in the chart. So you have, obviously the owners, shareholders, they care because this is their, this is their baby. They've put their time and money into this. You have, somebody mentioned the investors, the buyers, or the acquirers. Yes, of course, the investors definitely want to get their return. The acquirers or buyers are very focused on getting the best value for what they're trying to acquire. You have the advisors, so somebody mentioned lawyers. Yes, lawyers are one of the kinds of advisors. You have investment bankers, you have regulatory advisors, you have a number of folks who you will probably work with to make an exit happen. You definitely have the employees care a lot, and the management team. You will have customers, somebody mentioned customers care, and then you have suppliers and partners. And in addition to this, you actually also have a board of directors who will, be very involved, and also the general public, right? If you have a high-profile company, they care. Your reputation matters. It matters to keep your customers as you go through the process. So a lot of people involved. Sorry, yes.
Does the Department of Navy for an SBI-funded company have a voice or care about an exit?
I want to let the Department of the Navy answer this, but what I can say, just from my position is, I think they will care in terms of probably, I would say, export controls, or if it's a really important tech for the Navy, then who is, they probably want to know who's buying it, especially if you want to keep them as a customer. So that is my take on this. But Brian, anything you want to add? Yeah. Yep. Great. Thank you, Brian, for that. And I don't want to represent the Department of the Navy either. But that's the general sense, I think. If they are your customer, then what you need to keep your customer, essentially. So I covered this in brief, but I'm going to just reiterate. Your owners, your shareholders, and your employees, your management team are the most directly impacted, right? They care about, let's say your employees, they care about job security. They want to understand what, if they have stock options, what return are they going to get on this? Is the company culture going to change? What is career progression going to look like under this new system or, new management if it's an acquisition? Your management team also cares about job security. They care about the compensation they're going to get from this. And they also care about the future roles within the company. And what's really critical is that these are the folks that keep business continuity, right? So you have to make sure that you're communicating and aligning with them effectively so that your business doesn't suffer during an exit process, or your long-term vision doesn't suffer because you lose key people during this process because of poor communication or not structuring incentives appropriately. And so I really look at these groups as maintaining ongoing operations at the level that got you to a point where you can exit. So that's why these guys are really critical to work with and take care of. We talked about customers, suppliers, and partners, creditors, and lenders. I think of these as revenue continuity and operational continuity as well, right? So customers, if you need to communicate with them about the changes that are taking place at your organization, that's fairly critical, especially if you have certain kinds of contracts where they need to know who the acquisition, if let's say acquisition, who the acquirer is, and if they can renegotiate a contract based on change of ownership. And so that's why this becomes fairly critical, and that's something that can happen with suppliers as well. So let me give you an example. Let's say you are a hardware company and you have one supplier that provides really key critical component, and they are the only supplier that provides this, and it's a really big part of your product. And in the legal contract that you have with them, they have a change of ownership clause, which allows them to renegotiate their contract if the ownership of the company changes. That is a pretty big, well, it's a red flag to the acquirer because they might be worried that the supplier might terminate the contract and that makes your product much harder to produce. Or they might be worried that the supplier will try and renegotiate the contract to different, better, more expensive terms. And so that's why managing this stakeholder can be fairly critical. I'm not going to provide any solutions to this. I'm just highlighting that this is something definitely to watch out for. And it's why we're going through the stakeholders in this process. And similarly with creditors and lenders, right? If you have debt, and in your sort of, in some of the clauses, it says that they have the right to refuse an acquisition or a merger based on how risky they think the M&A is and how much it's going to affect their ability to get their money back. You want to be able to manage that, right? And be aware that that is something that they can do. And so that's why this group, in my opinion, is the revenue and operational continuity group that needs to be maintained because they help your valuation. If your customers leave, valuation goes down. If your supplier is, if it's tenuous, your acquirer can say, hey, this is not looking great. I don't know if I want to pay the price that that you're asking for. And similarly with creditors and lenders. This one, investors and buyers, acquirers, fairly obvious. I don't want to say that they can have opposing incentives, but investors want to get the highest return they can from their investment, and buyers or acquirers want to get the best value for their strategic goals. And so making sure that you as the owner or founder are aligned with your investors on what you're looking for in an exit and how much you're looking to get, and also making sure that that aligns with what your acquirers want is also important. This is a lot. So, as I go through this, feel free to stop me and ask me questions. We will have a long Q&A session after. But the reason that I'm kind of harping on this is because I do think that managing these groups can lead to a really successful exit, or can lead, or can hinder your exit or your negotiations significantly. So yes, advisors, you will have a lot of advisors. You will have investment bankers, M&As, lawyers, accountants, and other consultants who facilitate this process. They're really doing this, they need to get the best outcome for their clients because that is a representation of their work. So they are hopefully your friends. And my biggest question to some of the folks that we're going to have on the stage after is their real world experiences with advisors and what is some tips for working with them. But that's their role. And their role is also to help you maybe navigate the regulatory bodies, because let's say you're IPOing, the SEC has a number of regulations you need to get through, and then the stock exchanges themselves have their own requirements, and then there's a lot of governance requirements. Your advisors will help you navigate those. And really, the regulatory bodies are there to make sure that the market functions effectively. Now, whether there will be differing opinions on whether that is the case, but that is the general goal for them. Any questions so far? All right, cool. Okay, last two from me on the stakeholders. So I mentioned this briefly, but your board of directors play a fairly critical role actually throughout your company life cycle. Ideally, they are advising you, they're guiding you. Boards can be very difficult as well if you haven't got the right folks on your board. Their goal is really to represent shareholder interest, but that they work with you throughout your life cycle, right? And hopefully all of this, the way that you handle your whole exit keeps your reputation clear. So maintaining sort of community and public, especially if you're, let's give you an example. If you are a company and you have hired a lot of local folks in your town or region, and you're going through an acquisition, it may sound not that important, but actually managing your reputation in the area as you get acquired, making sure that people feel like you're a company that is worth working with and working for is important, because you can lose customers if you face reputational risk. You can have other impacts, but that is really critical. And I think we've seen how reputation impacts companies, right? There are so many examples of sales going down significantly when a company takes a stance on something, or when a company is seen as unethical or ripping people off. These are things that are that happen. And so there's a lot of stakeholders. And the reason that we have laid it out is because exits are complicated, and they're not just complicated because of the regulation or the valuation, the pricing, or et cetera. They're complicated because you have so many people who care and so many people who have something at stake. Before I get into M&A, any questions that I will attempt to answer? All right, okay. Okay. This is fairly straightforward. Mergers, two companies combine to form a new entity. Acquisitions, one company purchases another, and the acquired company becomes a part of the acquiring. As I mentioned before, the most common type of exit route for all sizes of businesses. So, the likelihood or the probability of your exit being an M&A versus anything else is very high. If you exit, it will probably be through a merger or an acquisition. Not very few companies, the rate is extremely low, I actually go through an IPO. And it may not even be worth it necessarily, depending on what you want, what your personal and business goals are. So actually I wanted to ask this, so maybe I move forward. Hopefully nobody saw this. But I guess, what do you folks think are the key reasons that someone goes through an M&A? Why do people want to acquire a company, usually? Yeah, definitely get their tech, yeah, for sure. Ellen? Okay, acqui-hire, yes, definitely. Buying customers and revenue, yep. Those are some of the big reasons. Anybody else that is? Donna, yes. Yes, yeah, similar, yeah, acqui-hire, definitely. Yeah, those are, yeah, you've covered most of the reasons. I added a little bit of my own, but those are the main, yes. As Brian said, I buy your technology to integrate into my product. I added this one actually. I buy your technology for supply chain integration, because that's something that we see a lot in the defense market. So I think it's worth highlighting that there is a lot of vertical integration in some aspects of defense. I buy your team because your team is extremely talented to work on my technology, or I buy your product to sell through my channel. So the difference really, and I want to highlight this, is between technology and product is when you buy a technology, you're integrating it into your product, versus when you buy a product, or when you buy a company for their product, you're actually planning to sell the standalone product through your channels, your customer channels. And so that's basically not buying revenue as, but it is increasing the market for the product that exists because of the channels or the customer acquisition pathways that you have. These are the main reasons. Any questions? Yes, that is definitely there. And I knew somebody was going to say this, which is great. Yes, there's also a lot of defensive plays. So you are developing a tech that, you're developing a tech that, is, poses a threat to a larger company. They buy you to get you off the market, potentially to integrate into their own product, potentially to sell on their own, but they're buying you to keep you from competing with them. So there's that one, less nice one, but yeah. Yes? So, you said if somebody's built a what technology? Ah. Yeah, so the question that was asked was, have you seen a company that has developed a tech or a product through the SBIR process, but the company could not sustain itself, and so basically got acquired by a larger company to be able to keep that product or tech going? So I personally have not, but I am fairly certain that that happens quite a bit. And actually, so this is why I want to make sure we bring on investors and founders on here, because they have probably seen a wide range of, things like this happening. But maybe I can ask Ellen, who is on her phone. Ellen, any examples of a company, Ellen is looking at me like, what? A company that has received an SBIR, built the tech, but cannot sustain the business and then sells to a larger company to be able to maintain that tech. Yeah, I'll give you the mic.
I forgot the company's name, but basically they had a bucket of photonics company that kept building, and they ended up exiting for about 100 million. Because I think so, whoever was buying it, I forgot, was after their IP. They're all around photonics.
Pretty common. Brian, any other examples? Okay, sure. But given the SBIR funding is, as Brian mentioned, not going to help a company scale, it helps you develop, the early tech. We can definitely see if you don't end up raising private capital and you don't have other ways to access capital, that is the fear, right? That you will develop something through an SBIR and it doesn't go anywhere because you can't scale it. So there's probably a litter of examples through history for that. All right, okay, let me keep going. So I spoke to a couple of folks to try and get you some insights, on how do you get the best outcome for an acquisition process. And so this is what I was told. I did a little bit of interviewing across the board. So I spoke to some bankers who work specifically on M&A at Catalyst, which is a big tech M&A bank. And so the first thing they said is, and this is, for early in your startup journey, a lot of people will say, don't think about exits early, just build a business, build a strong business. And that's fair, but I think what they are trying to say is that actually, yes, you should build a strong business, but you probably need to be aware of the things that can impact your eventual ability to exit. And you need to be aware of them early. So first thing I was told, keep the cap table simple and clear. It's not, make sure that the founders have enough ownership so that they're incentivized, because it makes it easier for an acquirer that's going through a diligence to understand ownership and negotiate the terms. So being aware of how you structure your cap table is critical so that it does not hamper your ability to exit later. Another piece of feedback that we got is, investors can be your champions, but sometimes they have different goals. And so making sure that you diligence your investor before you pick them, and that they align with your mission and they align potentially with the way that you're thinking about an exit is very useful. And hopefully we will get some examples for some founders of that and their experience with that. I was also told that some companies start meeting with advisors 5 years in advance, not to hire them or anything, but just to start to understand what they need to do or what it takes to be ready for when they do have to go through an exit. And so I did not know that, but that is interesting. And, maybe some of you are, fairly early in your journey, might be worth speaking to an advisor now, just so that you are aware and have all the information, even beyond this bootcamp. Another one that was interesting was build partnerships with the companies that you think could acquire you. So working with the partnerships team and, eventually, if the partnerships team and your company work really well together, and the partnerships team believes that your tech is critical, then they can actually internally run it up to corp dev and say, hey, we really need to buy this tech. We really need to buy this company. And so that is one way of being, kind of being on top of it, or being early and thinking about how you want to potentially exit. And then the last thing I was told is, network early with key decision makers at a potential acquirer. So if you can identify a company that you think could potentially acquire you at some point, and you're like, okay, well, these are the folks that are probably going to be the ones involved, and you can meet them at a happy hour or meet them at an event like this and start a conversation about what you're building, great. So that you're on their radar and that you're building a relationship over time. So hopefully this is useful, since I'm assuming most folks here are relatively early in their journey. But later in the company life cycle, this is fairly obvious, but someone told me, if you can make sure that you have multiple buyers vying for your company, then obviously you get a strong position for negotiations. My thought on that was that, okay, to get multiple potential buyers, you probably have to do the early work as well, right? You have to do the networking, talk to the advisors, build the partnerships to get to a place where you are so valuable that you have multiple folks trying to buy your company and you can set the terms of your valuation. I was also told by a banker, if you have not engaged with advisors before, the Series C is the right time frame to start to talk to them and get their thoughts or advice. And then the last two, which I have seen actually firsthand, is have adults in the room. So, so as you get closer to an exit, the executive team is really expected to have a strong track record, a strong professional track record, because the story that you're going to pitch for your exit needs to include the team, and that the team needs to be very strong for you to be taken seriously for that opportunity. And then lastly, and this, this makes sense, have at least one team member who has worked on an M&A before, because it is a painful process, and they can make it a little bit less painful as you're, going through diligence, et cetera. So that felt very common sense. Yes? I think advisors can probably fill the role for the last one, for the have one team member who has worked in M&A. But I think the adults in the room part you probably have to have, because that's a part of the value that you are providing, right? And that's how you're also, that's a part of your valuation as well. So works for the second one, probably not the first. First one, you probably need to have, a really strong CFO, folks that have, had a very strong and solid track record. I was working with the company and Series C, and I think were starting to think about how to exit, and so they hired a CFO, changed CFOs fairly quickly to make sure they had a CFO who had been through an IPO process, who could get them ready in terms of the governance, the financial audits, et cetera, to take them there. So that's kind of what you'll start to see, is that as a company is getting closer, they'll start to sort of get the executive team to a place where it's very experienced in what they're trying to do. All right. Okay. All right. Okay. So I will not go through this. This is something that you can go through in your own time. It's just sort of the sort of dry details of what these things mean. What the company sizes are, what does the management structure look like, shareholder involvement. But really, for the most part, I think that one of the things to say is that startups tend to be acquired rather than merged with other startups of similar size. So that's why I've been focusing mostly on acquisitions, because that is the most common thing that you will probably experience. Sure. Yeah. Do you want my? Yeah.
You may have an acquirer where your entity continues to exist. Why would that happen? Because you can't novate contracts, you can't novate security clearances and things like that. So they may be a wholly owned subsidiary of another company and those kinds of things. And the government does have a vote on how that stuff happens. So you really do have to, even if you're early stage, look at your intellectual property, your contracts and things like that to do that. So it's sort of unique in the government space for that to be sort of a step in the process. Long term, it would be one entity, but in the short term, there's probably a stepping stone in that process.
Business benefits and the contracting benefits, small business.
Sorry, did you want to say something? No, thank you for that, Mark. That's super helpful. And I think those are the kinds of insights we want to continue to pull out from the BMNT resources. The actual experiences, with the kinds of companies that we're working with defense, with government. So the office hours actually is where you can get a hold of Mark and ask him about all his experiences. Okay, great. Moving on. All right. Okay, so is this right for you? Is this something you want to do? And I don't know if everyone received this. I sent this out a few weeks ago, but we sent out a sort of an exercise on what kind of business do you want to be? Do you want to be a startup that tries to hyperscale, that raises venture capital? Do you want to stay a small business that is a part of the supply chain? Do you want to stay a legacy business, right? So do you want to hand over your business to your family? Or do you want to go through an exit? And so these are all things to consider as you think about your exit journey, or even just your business journey, right? And it's both business and very personal. It's about, what are your personal goals? Do you want to work in a frenetic pace, or do you want something that's more sustainable? Do you want to build a team really quickly, or do you want to build it slowly and step by step? So that's why this question is posed like this, right? Is this right for you? And I think I want everything we provide through Navy Private Capital for you to come at it from that perspective. Does this sound like something that would be something that works for your life? So obviously with an acquisition, you get immediate liquidity, right? The early investors, founders, employees all get payouts. There can be a lot of synergies. I hate using that word, but that is the case. It can be cost synergies, right? So you reduce, if you've acquired a company, you don't need the extra functions, right? Like HR, et cetera. So that can reduce, but you also have channel, like we mentioned before. You can sell a new product through your existing channel. So there's a lot of synergies like that. It can lead to accelerated growth, right? Because you've now got access to a larger company's customer acquisition channels or marketing or their manufacturing scale. So these are all the things that your business will get from being acquired, or even enhanced credibility or market presence. If your acquirer is a well-known, well-established company, these are the things you get. And if this is what you want for your company, then fantastic. The challenges might be, and this might change your mind or not, is that you will not have as much control, right? You have to give up a lot of control and independence, especially if you would like to stay involved in the business. That may not be, you may be able to stay involved, but will the decision-making be the same? Probably not. Integration in acquisitions can be very hard. And so you're merging different corporate cultures, you're merging different systems. Employees can, be unhappy, customer service can go down. And so those are things to keep in mind. And, that's an experience that you will go through if you sell your company and want to stay involved in it. And then, of course, if you're a part of a larger corporation, things are going to move at a different pace, right? There are different chains of bureaucracy that will get added. And are you comfortable with that? Are you comfortable with working at that pace? Are you comfortable with not having control? Are you comfortable with dealing with the integration challenges? If the opportunities are worth that, then great. And that is when you realize, okay, this is kind of what I want to do. And this is where I want to get to. But we want to make sure that you can reflect on it from a personal and a business perspective. Any questions? Sure. I feel like you can see it at all stages, but I want to ask Chris to potentially respond to this. Chris Moran, if you don't mind.
Can be bought earlier than hardware companies that have a long runway to demonstrating capability take a little bit longer to get that direction. But at all stages, we've seen everything.
And I asked Chris because he leads Lockheed Martin Ventures, so I think he has seen many more exits. Any other questions? Okay, great. All right. Okay, so we are at IPOs, initial public offerings. Sorry, I'm just looking at my notes to make sure that I have a sense of where we are. Okay. That's the question I should have asked. All right. So I think most people are familiar with what IPOs are. So I will not delve super deep into this, but first sale of the company's shares to the public, leading to a listing on a stock exchange. Really, the reasons that people do this is, unlike M&As, through an IPO, you actually get access to a lot of capital as a company. In an acquisition, that capital goes to, as returns, but it doesn't necessarily go to company building. Versus in an IPO, it can go to company building, and it provides the funds necessary for growth, for debt repayment, for other business activities. And that's, that's one of the key differences. Obviously, it provides liquidity for shareholders. Yeah, that's, across all of them. But it also potentially gives you the capital to be an acquirer. So, you can use your stock, you have the capital to do this. So the position is very different. And then obviously you have a much more public profile. And that means that there are a whole number of, when you have such a public profile and when you're IPOing, there are a lot more rules to follow to make sure that you are functioning as a company that is worth being publicly traded. And so that's actually a lot of what we're going to cover is what does it take to get there? And it's quite a bit. Okay, my least favorite part. All right, so this is, these are sort of, and again, I think for the details, please feel free to read in your own time. I will just cover the basic steps. But usually, you know, an IPO process can start a year and a half to a year, 2 years before the company actually goes public. And there's a lot of work that goes in to get companies there. And so first, obviously, the company's board has to decide, okay, we want to go public. We need to get ready to do that. That means, like I said, getting the adults in the room, hiring the right executive team that knows how to do this, getting the right advisors. So you've got selecting the underwriters who will help you set the initial price. But of course, there are other advisors that you want to get on board. I would say for defense, I'm assuming that there will probably be very defense-specific advisors that you would probably also need to have in the room. But that's, you know, the next step that happens in this. Then you go through due diligence, which is, you know, probably pretty hard. Folks go through the accuracy of all your financial information, you're filing registrations with the SEC, you're providing detailed financial status and business plans. To get to that, you have to go through a lot of internal audits and ensure that your governance meets IPO company requirements. So even to get to that step, there's a lot of mini steps in the middle. But this is at a high level what happens. Then you go on a roadshow and you pitch your company to a lot of institutional investors and try and get a sense of what price your company can sell, basically the price your company can sell at. So based on the investor interest, market conditions, and health, that's how the price is set. And then you go public. It sounds fairly simple with these steps, but I think there's a lot that goes into it. And hopefully we can give you enough of that. All right. Okay. So I guess, you know, I've mentioned this, but when do you think a company is ready to go public? Like, what do you think are the initial conditions required to get you there? Were you going to say something? No? Anybody? Amazing. Teddy. Yeah.
In this market, it really depends on whether people are ready to invest in a new public company, and that hasn't happened a lot recently. So unrelated to the company, it may be the market actually doesn't accept new public companies.
Okay. Yeah, that's definitely true. Anybody else? Yes, online.
This is from Lunar Station Corp. After a series of successful capital raise and accelerated market penetration. Thanks, Lunar Station.
Sure. That's definitely a part of it. I think you were going to say something.
So it actually depends. So I have a very good friend who did a multi-billion-dollar exit in Northern Virginia, and he delayed it for a number of years because he wanted to be a bigger exit. So technically, he was probably ready as a company to be doing IPO, but he waited because it would give him more leverage in the market, more money, more growth. So it's a state of mind. It's also a technical question.
Yep. Mark?
So there's a second question, which is why would a company go public, right? Because the why they would go public is a bigger reason because you lose control. And that why is usually that's the next pathway to get funding to do what you want to do, right? So, so that's really foundationally there because companies can be ready and they don't need to exit, right? They want to be 10 times the size that they are or anything else. But the why is they need access to that set of institutional money and those kinds of things to make it happen. And sometimes it's a good thing, sometimes it's a bad thing because nobody else wants to invest in the company. But that's one of the reasons that SPACs came up, right, was another mechanism to get to the public in a little bit more efficient path than what you'd painted before.
Thank you for that. And that is true, yes. And so the access to capital piece is basically the reason why. And as you mentioned, SPACs was one way for companies that were not being able to raise. Yep, that's basically what it was. I had another thought actually, but now it's gone. Your friend, sorry, the thought was that you said he wanted to wait, and so he wanted a bigger exit. What specifically did he do to get to that bigger exit?
He was clever, and he was very careful about financing, and he was profitable early on. So he wanted to maintain control. He had 50+% all the way through the process. And it's a company that essentially writes your script and everything else. It's assembly software language, or software. And he really wanted it only, I mean, he really literally could have done it 3 years earlier than he did it. And it wasn't in that particular case. You're right, completely. Sometimes the markets aren't ready. But in this case, he was very careful about taking outside money. He had good, he was really one of the first in the market, and wasn't worried about competition. And he just wanted to control the process. And, you know, it really was a state of mind, but he did all of his financing with that in mind, that he was not going to do it now. He's not going to do it now. He's not going to do it now. He's not going to do it now, but he was going to do it. So that's not a very good explanation, but from the outside, that's very clearly what he was doing.
I understand that, yes. He's your friend. It wasn't, yeah, you know, it's what he told you. Or what we can see, exactly. Yep. So I'm going to go through a pretty long list, but I will keep this fairly brief. So obviously the first thing is consistent revenue growth, right? You don't necessarily have to be profitable. As the biggest and most famous example, Amazon was not profitable when it went public, and it was not for the next 4 years. But you do need to show a clear path to profitability. And I would say that, you know, let's say if we take the example of Amazon, that was a very different market. And investors or Wall Street were willing to do that based on the projected growth. The market has changed, and people are not willing to provide the same, to basically, there's a more stringent set of expectations at this point, because we've gone through a number of tech IPOs that were not profitable and were priced pretty high. Some of them, Amazon was not, but some of them were. So the market has changed, and it's harder to do that today. And so actually market timing is extremely important as you think about how you're going to exit. This is a lot. And so I'm providing this just so that you have it and you can take a look at it. I will not cover this in detail, but really there are pretty high corporate governance standards is what I want you to take away. And the goal is to build the strong foundation that instills sort of public confidence and investor confidence in your company. And so the high level, you know, you need an independent board of directors, you need internal controls and, you know, risk management, you need internal audits, and you need to make sure that you're complying with all the regulatory requirements. And there's a number. And so again, I want you to be aware that this is something that has to be thought through, and this is what you'll be facing if you decide to IPO. But the actual requirements, we can think about another day, or you can read this. Additional requirements are really, you know, governance has to be documented, shareholder rights need to be figured out, and the way you engage with your shareholders. You need to develop an executive compensation plan and incentives to align with company performance. And so that's why IPOs are, there are many reasons, but that's one of the reasons that IPOs are much harder to do, right? Because the requirement or the benchmark to meet is much higher. Yep. Any questions? Okay. And I pull this together. It's a high level very, very high level IPO preparation checklist, but it gives you maybe on a visual understanding of all of the topics that need to be covered. And so, and I've put it in a form of like a project management form, but really, okay, well, financial readiness, audited financial statements, who's responsible, your CFO, you need investor relations, they need to establish the team, they need to prepare for the roadshow, who's responsible, your IR team. So just to give you, when you go through this in your own time, a sense of what you need to do and who's gonna help you do it when you're at that stage. Okay, so my last question for the day for all of you. So what do you think are the main challenges in preparing for an exit? Yes, time. That's one of the biggest. Yes. Anything else? And when you say time, do you mean market or do you mean just time? Personal? Yeah, that's probably a lot of personal time. Anybody else?
I imagine just the coordination discussions, you're going to be looking at multiple parties, you're having multiple conversations, some of them will go long, some of them will go short, so just managing your energy as well.
Yeah, hopefully I didn't overemphasize the complexity or scare folks.
I'd say just making sure your data room is in order. That's something that I've seen take quite a bit of time. And as an open source lawyer, making sure your open source software is well documented.
Oh, okay. That's one I didn't know. It's interesting.
I probably would say having a backup plan in case the acquisition didn't happen, like the Plaid deal with Visa. So you gotta have a contingency.
Okay. What would you say the contingency should be?
Depends where the company is, right? If they still have a lot of healthy amount of cash in the bank, they can sit around. If not, they gotta have ability to fundraise to keep growing.
Yep, got it. Anybody else? Donna, Mark. I'll get Mark.
So to that point, I think if you're contemplating an exit, how you communicate to your team and everything else to maintain, the line of what you're doing, when is it secret, when is it not secret? Because if it falls through, you don't want to, take out the capacity of your company to do business. You don't want people to leave and things like that. So it's a pretty tricky management perspective to keep alignment as part of that. And I would add on the challenges, knowing everything you need to know to actually do that, right? The legal ramifications, tax consequences, and all these other things are not part of your core business. And that means you're going to probably need to find an expert that knows something about those things, because you can't do enough research to figure out what can come and bite you.
Yeah, thank you for that, Mark. And stakeholders, managing your stakeholders, like we talked about, is very critical. Sorry, was there somebody online?
From Monday Piazza Online, she says, keeping employees on task and making them feel safe during the process the best you can. So there's another different one there. Thanks, Wendy.
Thank you. Yeah, so that's all the stakeholder stuff actually that we talked about. And that's the reason that I spent a big chunk of this bootcamp on that piece. I'm going to talk about I think some of this was covered, but sort of outside of your company to some extent, what can happen and what you should be thinking about. So timing the market is always a piece that needs to be managed. And so as an example, let's say M&As are kind of at a bit of a standstill right now because of the regulatory environment. Regulators are basically knocking down a lot of potential acquisitions. And so we're not seeing that. And I think the biggest example from recently was the Adobe Figma deal that I'm sure many of you read about in the news that did not happen. And it has basically put a little bit of a freeze on the market. From this list, I think the two that are really key, apart from the retaining key employees or negotiation, et cetera, is valuation disputes and due diligence complications. And I want to give you enough information to make sure that you can prepare for those if that happens, which is the likelihood of happening is high. So for valuation disputes, really, it's because the main reason is because buyers and sellers, they have differing expectations of, what the company's growth potential is, what the market conditions look like, and what the risk of this is, right? Your buyer is obviously want a lower price, and you are going to want a higher price. And so to justify the valuation that you're asking for, it's I'm saying fairly common sense things, but using the data and the projections to present a detailed financial and market analysis in growth plans. You're highlighting critical drivers for new product launches. You're highlighting the market share that you're expecting to expand to. You're highlighting customer acquisitions. So you're making sure that they are aware of every part of your business that is going to grow to justify that valuation. And then, of course, the intangible assets, right? Intellectual property, the loyal customer base that you might have, the brand strength. These are all things that are harder to capture, but you'll need to make the case that they exist to get the valuation that you want. Hiring a third-party valuation expert is also really useful. Always getting somebody who is objective and independent to provide justification for your valuation is useful, with who has nothing at stake necessarily. And if not, they can also just provide additional insights about your business that can help bridge that gap. So I think these are the ways to think about, eventually when you're dealing with a situation, what can you do to mitigate it? And then, of course, benchmarking against comparable company sales. So you see how the industry and the market is going in your industry and the valuations that other companies have been able to achieve. And you provide a price, you ask a price based on what you're seeing. For due diligence, again, I'm not going to cover this in detail because it's fairly dry and long. But I think, somebody mentioned a well-organized data room. That is critical, right? That's the second point here. All your financial statements, legal documents, HR, et cetera, are in a well-organized virtual data room. Starting that from probably your VC raises is a good best practice. Conducting your own pre-due diligence, right? Financial audits, legal checks on yourself so that you can identify before you go through a due diligence process what a potential acquirer might find. And then debts, right? Making sure that you are on top of any outstanding debts, clearing up any age receivables. These are fairly common sense things, but worth thinking through and making sure that you're aware of as you get closer to this process. And that is all that I have today. So hopefully that was helpful. Yes, Mark.
As long as the gap isn't too large, right? Let's say 20%. Oftentimes what happens is the offer will be at that 80% level, and then performance payments will be structured beyond that. So you don't have to argue over diligence. They just say, prove it. And it all gets caught up that way. So that's typically the adults in the room mitigation strategy for it.
Yeah, I'm curious about that as a employment analogy. Is it similar to like taking a lower base and then saying, hey, we'll do a review in 6 months' time, and then if your company does well, then we get bumped up as a result?
So there was another company I invested in years ago, Honest Tea, started by a couple Yale faculty who I knew, and I was an early investor. And they had essentially they had done a deal with Coke. I'm revealing stuff I probably shouldn't, but when they got to the final close after 3 or 4 years, one of their targets, the financial target, Coke discounted off against that because they had couponed for part of it. And the guy, one of the faculty, had simply missed that part of the deal. So it's like an earn out. And then I certainly know a number of people we probably all do, who miss their earnout targets, that they can't hit the numbers. So it's a really important negotiation if you go this way. Coke. And the irony was that Indra Nooyi, who was the head of Pepsi, went to school with all of us, and she turned them down. But since then, they spent 10 years, they didn't do anything with the brand, and Coke finally closed the brand down, and he started, Seth Goldman was a TEO, is what he called himself, has started a new company, and this time this company just took off right away because all the suppliers to the old company came back to him, and it's another whole business tale.
He taught a class that I was in, I think in business school, so that was a really interesting story, and actually quite inspiring in terms of starting businesses because he knew how to do this super well. Oh, really? Okay, that's awesome. Yeah, that's awesome. Thank you for that. So the due diligence part, I had more points, but I'm not going to cover them. You can read them on your own time. It's, the basics. We want to get to the insights part of this from folks like Mark, et cetera, founders, Chris, et cetera, who are in the room. I will hand this over to Stephen.
Yeah, thanks, Anushka. Can we just give a round of applause for Anushka? It's a lot of work. So I'd love to invite our panelists. We're just going to be doing Q&A, just live with the crowd. And I'm just going to do a quick round of introduction. So first up is Chris Moran. Chris is the executive director and the general manager of Lockheed Martin Ventures, the venture capital investment arm of the Lockheed Martin Corporation. In this capacity, he's responsible for leading every part of that organization. Prior to that, he was the head of corporate strategy and general manager of Applied Ventures, LLC, the strategic investment arm of Applied Materials. Next is Steve Weinstein. Steve is investment general partner at America's Frontier Fund, which is really investing at the next generation breakthrough technologies, and chairman of Roadrunner Venture Studios and deep tech incubator, incubating companies out of our national labs. And in addition, Steve has taught courses at Stanford targeted at lean startup, and he's a friend of the company. Next is Dr. Jamie Tenedorio. Jamie is a friend of mine and somebody that I've just been grateful to have in my orbit, and somebody that I worked with previously. He's a multi-time founder, CEO, and executive operator in med device AI diagnostic space. And he has 9 exits worth of stories. So just please feel free to just, point all the founder exit questions to him. And with that, I'm going to turn the table over to the audience. And I don't know if any of the panelists want to just say anything, introducing yourself or to the audience.
I don't know. You already did it. Why don't we just open it up to
Awesome.
People have been listening to questions about this topic. A lot of this discussion, though, I will say, has been a lot about IPO and SPACs and all that. There's another form of success, which is just making a profitable business that you're happy to live in, and just realize that might be a less stressful way of life, right? Rather than rushing, as someone who invests in Chris, we want you to go too fast, and sometimes we don't care that you have damage at the end. And if you keep control, like somebody said, 50% on one of them and others, you should just think that it's okay to have a profitable, nice business that's growing or even stable. And just don't forget that.
Don't forget that a tiny number of companies go public. Right? Tiny fraction. Yeah, we talk about
really tiny.
And we live in Silicon Valley, and it seems like everyone's going public, but it is a minuscule amount of companies. And I think Anushka did a pretty good job describing all the things you have to deal with, but there's so many nuances to that. I mean, the price negotiation alone, the gap between the way Silicon Valley values companies and Wall Street does is massive. So expectations are set really high, and then your hopes are dashed completely when the banker said, "Oh, you think you're worth 14 billion, you're only worth 1." And 1 may be good, but it's a lot smaller number than 14. And those conversations happen all the time. So yeah, it sounds great. I think the burden I'm on a couple boards, I'm sure you're on a couple. The burden of being a public company is really high. And so the effort to support that and sustain that, the costs to do the accounting and auditing, and it gets in the way sometimes, as like Steve said, of having fun and running a company and having a technology that you really love and a business that you like running. So just understand that, and in terms of the IPO track, those are kind of things you're looking forward to. I don't know, you've been through a bunch, so.
I was at 2 companies where we threatened to go IPO. It's a very expensive, lengthy process, and it's frankly the most costly way to get capital, I think. So just be careful what you wish for, be very intentional.
And I'll say the other part of that is I've been in 3 companies we went public, and all 3 I got kicked out.
That's because they finally do it better.
No, but that's really what happens. You have other people voting on your, on why you should be there.
Awesome. So questions from the audience. Yeah, I'll be coming around.
Thanks, guys. Well, I was curious, and Steve, I think you brought up a good point. So I'm curious, if the average sort of stats approximately that I've read have always been about 70 to 90% of merger and acquisitions fail integration, right? So usually either the tech is shelved or the team is, management teams are laid off, some team are acqui-hired into other teams, etc. It sounds like most of the exits don't really work, and yet people keep doing this. They keep buying companies and merging them in and still set this as a direction. So, I'm curious on the experience and the stories of where you've seen this work, and what is it to increase the opportunity so that your company is not getting shelved or killed if you're exiting?
So it depends on what the measure of success is and which side of the looking glass you're on. It is not uncommon for a company to be acquired by a competitor or a potential competitor in the space to either acquire the technology in the team or eliminate the threat. So that actually happened, at least from my experience, happens more often than people think. So, what's success? The last company I sold, I wound up selling to a competitor. We were 1.5 years ahead of them. We had regulatory clearances. We were in the market. They paid a lot of money for it and shelved it.
I was also part of a company that Microsoft bought, paid, seems like small amount of money now, but in those days it was a reasonable amount, $140 million, and they did it strictly to shut us down, inherit all our customers, because they had terrible tech support, and our company had great tech support, and that was the key, what kept our customers. And, and everybody, so great, we sold the company. They try to hire everybody into various groups, but most people ended up leaving. Yeah, I mean, it's traumatic. Remember, I mean, the thing you should realize is you inherit the business model of the people you're working with if they're giving you money or acquiring you. And you have to think about that. Your venture capitalists or your people who are giving you funding, you have to think how they think. Have they had a recent exit? Is that person up to making a small deal versus a big deal if they have some control on the board? If you're getting acquired into a company, what's their real reason for acquiring you, not what they're telling you? And I mean, and those things are hard, and it usually, as you point out, if it's an acquisition, it doesn't usually come out that you're in the new division of X, and that's why earn-outs don't happen. Is the company looks different the day you get acquired. That's why I would say never sign an earn-out more than 2 years, and I would be optimistic if it was 2 years.
Yeah. They're incredibly hard to police and enforce.
Yeah.
Because people are generally excited about the process of the transaction closing. They don't negotiate that earn-out agreement very well, and so it's hard to measure, and people exploit the opportunities and the gaps. So it's generally not a great thing to do. And a lot of companies, I know my company tries to stay away from them for all those reasons because it can be exploited on the other side too. But to this point, I mean, I've I've been in large companies my whole life. For somebody to recommend my company to take them off the market, that has got to pass their radar.
Yeah.
Because no M&A group is going to recommend a deal that kills cash flow or reduces profits or just wastefully spends the company's money. That is not the way these companies look at these things. They generally look at an acquisition in terms of accretive cash flow. I mean, it's down to that. If you're not generating cash, you're not going to be bought. There may be some tech, and acqui-hires is an exception to that. That's happened a lot around here. It's not as popular in the rest of the world to do that, but generally every M&A professional that I work with, it's all about accretive cash flow. If you can't do that and do it to an acceptable level that matches the price they're going to pay, you're not going to be a target. It's as simple as that.
Wonderful. We have another question from the audience.
Hi, I'm Kevin, and my company develops underwater drones. Since the 1970s, there's been 2 unicorns in the defense industries, and since 2023, there's been 8. Do you guys see this as a trend that's changing, and if not, is this a bubble because we're at a war, or there could be a continued demand from the foreign startups?
I'm actually trying to understand it, to be honest. 5 years ago, Google got raked over the coals on Project Maven, and people left the company because they were working on a defense program. Now all of a sudden, companies that are literally making weapon systems and get funded by VC. So if you guys can explain it to me, I'd like to understand. Working in defense now for 8 years, it's a brutal business. It's a very low profit margin business. You have to have stamina, determination. I mean, there's a lot of things that are different characteristics.
Sorry, we have an issue with the spike. It sounds like we hear it here, but we can't hear it through the. So if you guys can
Another one?
share.
Would you? Where was I? I would love, honestly, I'd love, in fact, we're going to meet with a bunch of firms over the next couple of weeks to try to understand the phenomenon. Is it a bubble? Is it, like you said, is it the current events that are getting interest in the space? But when you look at pure defense companies that have to play by what's called the foreign acquisition requirements, it's a tough business. And the government does not like to let people make outside profits in that business. So it sort of goes against what venture capital money is raised for, right? You want a big multiple on your revenue, your earnings. Usually comes with higher than normal profits. That's not the space that we're in. So I think through OTAs and other things, they're letting people work around that for a while. But if you're a pure defense company, at some point, you're going to have to comply with those rules, which is another level of accounting and stuff on top of what you just talked about. But talk about TINA accounting and the other things we have to deal with. It's tough.
And as Chris points out, if a defense prime acquires you, they're very limited in how much they can pay. It's strictly based on their business model. And, I don't know what metric you would say if you acquired a company.
Basically free cash flow is what it comes down to, right? And there's got to be a multiple, like our company trades at 2 times revenue. So it's going to be in that range. So some of these startups that you see trading at 28 times revenue right now on the private market, like what, how, why? Is the growth level going to be that high? They're doing the same thing we're doing. The defense industry is not like the commercial business. You can't create a slick advertising campaign and create demand. The budget is fixed. It's one pie. The pie is set at the beginning of the year for the year or for a couple of years. And everyone goes and chases those wedges of the pie that they're after. So it's a different business than selling perfume or cookies or whatever anyone else is saying. You can't make it larger by willing it to be larger. It just doesn't happen that way.
Oh, if it's dual use? Yeah, of course. Then
Nope.
Not for you to acquire.
We
but
would
for
throw
others.
it. We would totally devalue the commercial side because we have no Lockheed's 99% defense. We sell $100 million a year of helicopters out of $66 billion. So commercial has zero value.
No,
to
for
us.
you.
Yeah, that's what I'm saying, for us. He
Yeah,
asked me.
for you, but dual
other
use-
companies, yeah. I mean, other
Dual
companies.
use,
that-
I mean, you've seen a lot of companies, that are dual use. Now, he just pointed out how you might get valued by your acquirer, right? They might say, we only care about your commercial use versus your government use, right? So you really have to think about might be your acquirer, or if you go public like a Palantir. Right?
But the other side, as an investor, I love that idea, right? Because that gives you multiple markets to attract and sell into. So as an investor, it's great. But for Lockheed to acquire a commercial business, it's really hard. We wouldn't know what to do with that part of the business. We're not looking at anything right now because
What was the last big
because the FTC
acquisition?
won't let us buy anything. But last big acquisition was Sikorsky. 2016, I believe, early 2016, we paid $5 billion, I think, for Sikorsky, roughly. I can't remember. I wasn't involved in that deal. Something like that.
Hi, this is Chris, investor at PaperJet. Question for you, Chris. I think you might have just answered that, but I'll just shoot it anyway. Given that you're running a venture arm, I like your perspective in terms of trade-off. If you invested in a key company that can be very beneficial in terms of technology for the corporate company, how do you think about it in terms of acquisition that's strategic compared to a possibility to let the company just be independent and scale to multi-market, especially since it's, in key areas like electrification?
Yeah, it's a good question. The purpose of my group is basically to build suppliers, to build out the defense industrial base. When the Ukraine conflict started a few years ago, the government called up Lockheed and said, hey, we need 10,000 Javelin missiles. The government for the last 10 years had bought 500 a year, right? And all of a sudden they want 10,000. So everyone's thinking that we've got empty buildings with idle workers and spare parts sitting on shelves and we could just crank those things out. Well, it's going to take us a couple years to get to that point. But what that exposed was the problem in terms of the scalability and resiliency of the U.S. supply base. And so we realized that we need to have better, more capable suppliers that can scale to some degree on their own, can invest in their own future and growth, meaning that they are, revenue and profit generating businesses and they're reinvesting in their health. And a lot of the suppliers that we have, Lockheed has 25,000 suppliers, about half of them are really, really small. Small to the point where the analysis we did says we buy like less than $10,000 a year from them. It's incredibly diverse, but not very resilient supply base. So part of my effort is to help Lockheed find companies that will be able to respond to those types of demands and allow us to grow. So we're looking for scalable companies to invest in, right? Small companies that want to be big companies is one way to think about it.
Hi, my name is Mike Zani with Digibeam. Question for Chris. Yes, no, for you. Could you tell me the difference between, what you guys are looking for? Do you look for stuff outside of Lockheed's strategy or just for Lockheed's strategy? In other words, do you just serve Lockheed versus Raytheon, who Raytheon Ventures they're on Wall Street. They'll do whatever, okay? At least that's what they told me outright. So I just want to understand who you really serve. And if I come to you, am I competing against your internal guys who are trying to come after your money as well? Why does John Fontana he doesn't even know who you are, okay? And then my last question is, and you don't know who John is, and the last question is, when you want to buy a company, what are you actually looking for? In the sense of, let's say you have a company that's making a product or developing a product, where does that company need to be in relationship to government contracts? Out of SBIR and into a phase 3, beyond a phase 3 into production, what are you looking for in order to get invested in that?
Did you write all these down? Okay.
I got them all.
I can't keep track. The first one was top of mind. So how do we look at deals? So It's a little both. We call it inside out and outside in. So my group, we're a group of 12 now, actually pretty good size. We look at 2,000 deals a year. So that's a pretty significant amount a company that flow through. Now, we're not taking a long look at a lot of them. We're probably taking a good long look at about 100 companies, but we see 2,000 to get to those 100, and we invest in about 20. So it's kind of the same ratios you'll see in other venture firms. And the reason we do that is to make sure that the cream rises to the top, basically. Because if you only have one deal, that looks like the best deal, right? So I told the team, you better have 10 at a time, and it should be like this, that you tell me which one's the most important. So we look at those, and we screen against 14 tech areas given to us by the CTO. So we start there. But, as you're going through those 2,000, every once in a while, something really different shows up, not on the list, but you can map it into some really interesting use case or valuable program capability, and those are ones we invest in too. So, we're oftentimes talking, we talk a lot with our business groups. We're on monthly calls and sometimes weekly calls with them to find out where their tech gaps are or needs are, and we go shopping for that. But the other side is we oftentimes see things they never imagined and bring that in, and they love that too, and we make those investments as well. So it's a little of both that we get. Now I forgot the other 5 questions you asked. So. Yeah.
Please finish.
I can't remember the.
I'm going to ask a question, and then I'll definitely hand it over to you, Jamie. You've been through 9 exits, and I'm sure this is a wide range of experiences. I guess, what was your smoothest exit, and what made it smooth? And then what was your hardest, and what made it hard?
There are no smooth exits. 0. So, and just to be clear, I've been through 9 M&As, half on the buy side, so maybe that's an entrance. I'm not sure. So what was the smoothest? The smoothest was when we purchased a customer who was refocusing their business. We were a design services business. They had been a big customer. They were focusing their business more onto the services side of their equation. So that went actually very smoothly. And the most challenging one was being purchased by Samsung. The business was a semiconductor technology business that had been for the prior 6 to 8 years primarily DoD focused. Turns out Samsung wasn't DoD focused. So we went from sort of a government accounting system, DoD contract sort of mentality, and then the next day we were all in a commercial environment, and we were starting to sell products shipped within the corporation, and we're getting calls at 3 o'clock in the morning from the head of the TV production line in Suwon, Korea, who's saying that effing IC you sold me is bringing down my tuner line. I have 30,000 TVs that have to come off in the next 10 days. You need to have somebody here. So it's sort of a different milieu. I'm not saying one's good or bad, but that was certainly a learning experience for me. Maybe I never thought I would wish to go back into the DoD after that. But
you bring up an interesting, this discussion is, what is the trajectory of your company? Another way to think about it is certain companies get acquired and their only path is to be acquired mostly. Like I assume you've been in medical devices, and that's, so if you make a medical device, there are you're most likely never going to do anything but get acquired.
Pretty much guaranteed, yeah.
Right, and so in your business, you should think about if you want an exit, what kind of exit is typical for a company like yours? And in medical, it's at what stage, do you usually get acquired?
Well, in any regulatory context, I think you have to take that into account. In medical in particular, if you're on a 510K pathway, for example, the closer you get to the 510K or through clinical, the more your valuation goes up. but it's a long pathway. Even a conventional 510K, not esoteric medical product, it's about a 5-year pathway to get from concept through design, through regulatory, because you have the whole QMS infrastructure to deal with, and then the FDA and all of that. So that has to be in your planning horizon, your use of money horizon. And just, the other thing that I would say is you're always raising money. You're always raising money. So whenever you get asked, when's your next raise, the answer is, well, like now.
I think there was a question here.
Hi there, Peter from Bimodal. I have 2 questions for the panel. One is, how do you guys think about hardware technology moats versus software technology moats? And then 2, how does the song and dance for like exits and acquisitions compare with that of just like other fundraising like VC or debt financing?
Well, for me, the moat question is generally people dislike hardware a little bit. There's less of a excitement over hardware. It's interesting if you have a moat there, but remember, in an early stage company, a moat is not a patent, right? And a lot of people confuse a moat with a patent. Okay, I have a patent on something, therefore I have a moat. No, you have a patent that's been unproven in the marketplace in 7 years before anybody cares. Okay, other than in pharma where patents are blockers. And so for me, I tend to lean towards hardware now, and so I like that idea, but the moat has to be something like a semiconductor that only you have made, right? Or it's a sensor that is unique. In terms of software moats, it's a little harder. Usually that's, it's how, a lot of companies, their software moat is 18 months of a team right now, right? And so those are a little harder to defend, at least for me.
Nothing to add. I agree with everything.
Yeah.
I think around 10% of our investments have been software, which is a little different than normal. So we're mostly a hardware investor in everything from space technology to quantum computing. We look at software is a little hard.
To continue the trend, I'm going to ask 2 questions. So the first one is, if you have a dual use technology, does it make sense to split the company so that you can do the acquisition separately, because the valuations are very different in the defense space than it is in the non-defense space? Also, if there's ITAR control issues, you can split the technology to avoid the ITAR confusions. And then the second question is, if you don't need funding, does it still make sense to partner with a venture for the experience and the guidance going through the process?
So I'm going to answer the
Which
second one
which
first.
process?
The second one. I'm going to answer the second one first. I would say stay away from venture, period, if you can. Even though I'm a venture capitalist. I know. No, if you have a business that is generating cash and you can do it alone, do you want to get married to someone else, right? Because their goals are different than your goals. And if you need the capital, it's an incredible good way to get capital. But if you don't, what's in it for you, unless you need it, right? And so that's, if you want an additional boss, then and you need some money for scaling. That's my opinion.
There's a clock ticking on that. Usually on that, we don't have that problem. We don't have a fund that's expiring, so we're not under those pressures. But a lot of these funds have a time limit, right? They used to be 5+2, or now they're 7+3. So they have a investing window, then they have a harvesting window, and then they have to return all that capital, right? And in that period, towards the end of their fund, and this is another thing to check, what fund are you investing out of? Oh, it's that 6-year-old fund. They got 1 year left. There's going to be pressure on them to monetize that investment in a year's time. And you'll start seeing really weird things happen at your board meetings when that's the case, right? So to Steve's point, venture money is very expensive. But if you're on a a super high growth trajectory and your value is going to increase rapidly, then it actually is a low cost. But if you're kind of in a slow growth kind of thing, it's very expensive money to use for that kind of trajectory. So I would agree with Steve.
And then for the first question?
Oh, no, I wanted to actually follow up on it.
Okay, so on your first question, it's really hard to split a company in half because the tech is most likely coming from the same, group. So, what your people did for a while was make federal systems divisions. Okay, and they still do, and you buy the product from the main company. And so you can keep all the rules, the time cards and all that sort of stuff on the federal system side. And that's a pretty common way to do it. And I think Silicon Valley should do more of that, in having those divisions. But if your core tech comes from the same group, it's tough.
One other thing on that is that we're in a very weird sort of regulatory environment with CFIUS and FIRMA and all these things. And, we've had a few instances where the ownership of the company wasn't clear, foreign nationals involved, and splitting that company was an important part to retain the government contract, right? To make sure that those things are separate from that. But as a business construct, I agree with Steve. It's an expensive way to go if you don't need to do it. And even with that situation with the foreign nationals involved, you're still buying the tech across an impermeable barrier, which we know is permeable because the people are on both sides of it. So it's a little messy from that standpoint. But I just have to say it's a very difficult environment we're in right now. With the world conflicts are going on, everyone is hypersensitive about where their money's going, how these products are getting into their systems. And that's why my comment about software is hard for us to buy, because we don't know where the base code, particularly open source software, where are these algorithms coming, who's had their hands on them. We've heard about this event where some guy got into, what was it, some base code for Linux or something. Right, and oh my God, that caused unbelievable turmoil to do that. So everyone's hypersensitive about software right now because we really don't know what's in it to get to that.
Wanted to follow up on that question actually from the operator or founder perspective, Jamie. I guess what are some lessons learned for you in terms of working with venture investors and how that aligns with, exiting?
Well, I would say, I would agree, if you don't need it, don't go through that process. There are lots and lots of companies that are 20, 40, 50 people that operate at really good margins, make money, and they've been around for a long time. If that's your mission, be intentional about that. I think the reason to go to venture capital is obviously the need for cash, but it also make sure that if you know that route, that you choose your investors, who you're. Somebody mentioned it's like getting married. Yeah, it's like getting married to a blind date sometimes, so don't go down that pathway. So be intentional. Make sure that the investment theses are aligned in some way. I've had some incredibly great experiences with going with venture capitalists. I've had some that weren't pleasant dining experiences, but for me, my personal view is good venture capitalists, and there are many of them, are, yes, they have to have that LP construct, but they are driven by building successful companies. And so I guess that's the way I would put it.
On your unsuccessful experiences,
Looking back now, what could I have done differently? I would, for all of the founders in here, I would counsel them be very aware of who your investors are, the quality of the investor, and where they are in that fund process. Make sure you understand what a cap table is and what the implications of that are. And particularly as it relates to investor rights and governance of the company. A good board with good investors can make the company and propel it to be extraordinarily successful. You have a board that where the investor interests are not co-aligned, that's not a fun thing.
Awesome. And that is time for our Q&A. Give it up for all of the great answers that we got. Thank you so much. So now we're going to go into a short break. We did eat into a little bit of break time, but please come back in 10 minutes. We're going to start 3 o'clock on the dot. Steve Weinstein and Pete Newell will be doing a fireside chat, and so that will be coming up next. See you all in 10 minutes. Thank you.
So hello, can you hear me? Okay, awesome. Yeah, thank you so much, everybody, for being here. In this session, I really wanted to deep dive into business model generation and hypothesis testing and validation. And there's really no two better people to talk about this topic than Pete Newell, founder and CEO of BMNT, and Steve Weinstein, who was just up on stage. And the reason why we wanted to delve into business models when we just talked about exits is, as Jamie said, in order to have an exit, you need to build a successful company. In order to have a successful company, you need to build a successful business model. Part of that is product market fit. Another part of that is founder market fit. And really in today's conversation, we'll be deep diving into the principles of discovery, validation, and finding product market fit. With that, I wanted to just briefly introduce Pete Newell. As I had mentioned, Pete is founder and CEO and chairman of BMNT, as well as BMNT Ventures, which is our venture accelerator arm. Prior to his time founding BMNT 10 years ago, Pete was a colonel in the US Army, leading troops in the battle, and then served as the director of the Army's Rapid Equipping Force. And I'll let Pete talk about that when he gets the chance to speak. And you all know Steve, investment general partner at America's Frontier Fund and chairman of Roadrunner Ventures. Pete, floor over to you to introduce yourself to the audience and just give any introductory foundational thoughts on business models, customer discovery, anything you want to say.
How many first-time founders are in here? Okay, I know how you feel. Trust me. And a lot is missing from the story. I will tell you that I was an infantryman on the battlefield, and I was at one point handed a job. And it's called being the director of the Army's Rapid Equipment Force, which is essentially the Army's skunk works. And they gave me $100 million, and they gave me no bosses and no guidance other than go out on the battlefield and find things and fix them. And I found that the organization I adopted was really good at the product end of doing things. They could build products against something, and they get it to the battlefield. And you know, being somebody who grew up on the battlefield and spent the better part of 30 years at war someplace, I would look at things and say, you know, I see what you're doing, and that's a beautiful product, but it's useless. Because it only solved a part of the problem. And by the way, the problem it solved changed so fast that the product you sent to the battlefield is sitting on a Connex someplace gathering dust. It's useless. Or it was a perfect solution, but the form factor sucked so bad that nobody can use it. You know, the battery is too heavy. And the great examples of counter-improvised IED equipment that people are supposed to use on the ground, like a minesweeper, handheld gradiometers that could find things that were buried. But nobody thought when you threw a 5-pound battery on the end of that stick and you asked somebody to wave that stick over 6-inch square things for 8.5 hours, that their arms fell off, or that they got really sloppy and they missed things. So my experience on the battlefield of watching what I didn't understand was product development versus product discovery was missing this thing called problem curation. Was this process of deeply understanding not just the problem, but the context the problem existed in. How long the problem would stay the problem because things changed on the battlefield so fast, and how long it took you to gather the technology required to solve it. So I spent the better part of 2 years developing this model of problem sourcing and curation that helped us rack and stack the problems we found, and pulled them together, and then, just like a venture capital does, we look at, here's our top 10 list of things we're working on. And if you ask me about one of the things on that list, I could show you 140 examples of different ways that thing presented itself on the battlefield. And then I could tell you why we were doing the work we were, and when we would stop doing that work if we slowed down or sped up too fast. So really the fascinating part of coming into this kind of world with no business background, but simply understanding and deeply understanding and emphasizing what the problems on the battlefield and understanding the pace of the technology changed the way I looked at everything that happened around me.
Thank you, Pete. Just a question for the audience before I give the floor over to Steve. So there was a significant number of first-time founders in this room. How many of you would say that you found the market, that you're pretty confident in the market that you're attacking? Okay, wonderful. And how many of you have then started to productize and to sell into that market? Okay, that's great. And then how many have not found the market yet? They're still in search of the market. Okay, so a couple of hands. Okay, great. Really the story of today's conversation is gonna be, us going through 25 minutes of Q&A with me, and then opening it up to you in order to talk about some insights on your end and questions for the panelists on how to find product market fit, test your hypotheses, discover problems, and discover solutions. So with that, Steve, I just want to give the floor over to you.
On that. So those people who have product market fit and have a product, how much of it is a product versus customization? So more than 90% is serial numbers, product, and 10% is customization? Or anybody in that ratio? A couple? Good. That's where you're headed. That's right. For those of you who are not in that ratio, it's tough to scale, right? And you have to figure out how to, as a product market fit means, I have, the old Henry Ford, I have a car only in the color black, or now Tesla, only black and white and red, and a little blue. So just think about it when you think of your product market fit, what it really means. It means that, and when you think of product market fit, I think some of you, how many of you have more than 5 customers or 2 or 3 customers, even though it's the same government? Wow, this is great. So, for those of you who are at that stage, at least for me, was that you have to constantly think, am I keeping in touch with my customer? How I would say onto your company is well into a couple hundred people. If you're not talking to your customers and doing discovery, even every week, you're making a mistake. I can't tell you how the plane diverts off thinking that the trajectory is right, okay? And all of a sudden you wake up one day, and that's just for all of you. Customer discovery, learning, getting product market fit isn't a moment in time. It is a constant recycling of understanding, because your view, the same way your customer view is changing, right? If you asked people 2 years ago, what's their AI strategy, they would have looked like you're crazy. Yet if you are building a product, and I know a bunch of companies were building AI products before chat came out, they completely, try to keep shoehorning their old product into the new, and they haven't realized how their customers changed.
So I'll pile on to Steve, and the lesson in a lot of this is you have a conversation with somebody, and I get on people who say, well, I'm doing a survey. Surveys give you no context around what people really think, and it gives them no context around what you're talking about. If you don't have conversations with people, the first time you meet them, you start asking a bazillion questions, their brain is kickstarting kind of slow, and it's not keeping up with you. And it's not until you circle back later after somebody's had time to think about something that the conversation actually starts to get rich. I would take it even further, and I did this on the battlefield, and I say it's still true today. The first time you'll have an honest conversation with a customer about what their problem really was and the product they really wanted is when you hand them a product. The very first time you'll have an honest conversation is you hand them something. So the first, best, fastest, even if it's the crappiest thing you can put in front of them, you give them something, that jumpstarts the conversation and helps you get to the point where you're getting context. And they're spending more time talking to you about why this thing isn't right. Because in the process of telling you why something is not right, you're going to learn what the right thing is. The first, best, fastest thing you can put in somebody's hand jumpstarts that conversation. And then you can't stop doing it. You have to keep going back.
Absolutely. Going off of that, Steve, question for you. Can you talk about, obviously you've taught lean startup at Stanford, where, you got teams of university students that then start companies and go into markets. And obviously, you founded a venture studio that invests and incubates in companies that go from lab to market, so very early stage. Can you just talk to us about the customer development pipeline? How starting at the problem, is the most efficient path to market, and what other insights you may have on being problem-centric at first and then moving into the solution?
It's a long question.
Yeah.
I can't pay attention that long. So you first have to decide on what's not changeable, right? If you're taking tech out of a lab, you're tech looking for a market, right? And it's usually immature. It's usually TRL 2, 2.5 if you're lucky. They'll tell you it's 3.5 or 4. But then you'll get to know it. And so that becomes a firm foot in the ground, okay? If you really think that's the technology you need. So it's also the hardest path to go, right? It's looking for a market most of the time, unless you have something unbelievable, anti-gravity paint, you kind of know immediately, cure for cancer. But so when you're doing discovery, you have to decide what's not changeable, okay? What's not, hard to change. And tech is hard to change if it's, material science or stuff like that. So then that kind of is going to guide how you find product market fit. It's a much harder path. I'll just tell you it's a much harder path because you're constantly thinking the other side doesn't get it. Our new material is the best new material. And so for me, you have to decide where you're coming. At the venture studio, we start with an insight. We don't start with a technology. We then go shop for the technology. Okay, so like an insight is robotics have gotten to the point where multiple robotics can talk to each other in a way that's never been happened before. Manufacturing lines have lots of dirty jobs. Okay, maybe we could do a human-assisted robots for dirty jobs. Using multiple robots coordinated. Okay, that's just this kind of not really something I'm doing. But then you could go out and see if you can find some interesting technology, and you could go out and find out who has those dirty jobs that they would die for you. I would say, we do in the class, we say talk to 100 people. 100 people in 10 weeks, 10 a week. All right? I would say that's a little low. I'd say if, after a while, it needs many more months of it. So for me, it is, going out, understanding the problem, as Pete said, curating the problem to a point where you understand it, and then going back and deciding whether your technology really can meet that need. Remember, no one likes to call your baby ugly. Okay, so when you go to a customer discovery, nobody likes to say, that technology is terrible. That idea is a terrible idea. So you really have to have your sensors up to realize if you're really solving a problem that they must have. Right? If I asked any CEO, and it depends upon the job. Remember, when you talk to someone, you have to look it through the eyes of their job. If they're the CFO, it's about saving money. If they're the head of sales, it's about selling more. If they're the CEO, it's profitable and maybe even getting venture funding. If I'm the project manager, it's solving a problem. So when you think about customer discovery and do product market fit, you got to realize everybody in that chain has a different viewpoint, and it's so easy to convince yourself that the one you heard is the one you want.
Absolutely. Pete, any thoughts on that?
You're familiar with the business model canvas, right? How about the mission model canvas? Couple, okay. There's a difference, particularly in defense world, when you're trying to understand what product mission fit is. The product mission fit is really the definitive answer that you truly understand the problem that your clients' people have. And here's what I warn you about the government is the buyer is not the user. And that's the hardest thing in the world to get past people who do commercial stuff. The buyer is not your user. The user is somebody who's a ways away. Your goal is to get to the user. Sometimes in spite of the buyer's insistence that you don't. But product mission fit is really determined that you truly understand the problem you're trying to solve You have disaggregated the complex stuff down into bite-sized pieces, and you know where to start. That product discovery really starts, and it's really technology agnostic. I used to say it, particularly the rapid equipping force, that we didn't care about the tech, we cared about the problem. And with that mentality in mind, it allowed us to cashier pilots and experiments that we did because we didn't care about making them successful. We just cared about whether they taught us something about the problem, about the user, about the environment, about how the technology integrated with other things, until the point that we decided we had an answer that we could deliver in time for it to be useful. And at that point, we declared product mission fit. And then we swapped to the business model canvas and said, how do we build a company, or how do we help a company build the product we need fast enough to deliver to the battlefield? It's a little bit of yin-yang, because you got to have to understand both in order to be successful. It's a mistake to leap the product market fit in the defense world before you understand product mission fit.
Understood. And that's where I think, starting with the value proposition is the first initial thing that you focus on, and as well as the customer. So that actually leads me to my next question. As I was preparing for this panel, I came across Steve Blank's definition of a startup, which I thought was brilliant. He defines a startup as a temporary, not permanent organization, as a temporary organization in search of a valid business model. This is very different than a big company or a company, which is defined as a non-temporary organization with a repeatable business model. And he also defines, that any company, he also says that any company can be defined with the 9 characteristics of a business model canvas. So how do we get, this is a question for you and for Steve, how does one get from here to there? So what does the roadmap look like from you being a temporary organization in search of a business model to then validating this? So obviously when you start, right, you're just putting up stuff against the wall and seeing what sticks. How do we go from that to having a repeatable, useful business model that is generating not just revenue, but generating value for customers?
I hate business models. And it's not that I hate business models. I even have to remind people of this graphic behind me, I think, on the wall, because I'm looking at it up there. It's simply a roadmap that shows you the things you have to do that you have to learn. So it's not an exercise in filling in the block, it's an exercise in doing the homework required to figure out what goes in the block. So this is a roadmap, and a roadmap requires a hell of a lot of work, and a lot of customer discovery, and a lot of MVPs, and a lot of hypothesis killing in order to come up with what Steve would say is fact. We start with a table full of assumptions, and our job is to turn those assumptions into facts. And you can't do that sitting in the office, and you can't do it inside your own head, and you can't do it inside an echo chamber of the people that are looped around you, who are your happy clan that are supporting and patting you on the back. You have to get out and talk to people, and you have to learn about the environment. You have to learn about the people and their wants and their needs and the conditions they're in that will eventually help you get the right things to put on the map. First, it'll help you figure out what the problem is, and then what the solution is. And then it'll help you figure out what the pathway is to delivering the solution and who you need to recruit to you as part of a team in order to make sure that pathway helps. One of the mistakes that people make all the time, and I'll talk to you about the anecdotally ref, is they build a team, then they assume that team is the right team to stay with them forever, rather than building a team to do the discovery required to figure out what the team is that needs to go forward to scale the product. There are a lot of people who are really good at the front end who are absolutely useless at the back end. And unfortunately, as a startup founder, if you give people like that equity in the front of the company, you're not going to have anything left to give anybody at the back end of the company when it comes time to scale. And the venture capital folks will look at you and see that coming. I used to have this conversation with my folks as we started, big, long, complex things. And we built some really exotic stuff in a short period to deliver to Afghanistan. And the rule was that we had a small table that sat 10 seats. And the only people who were allowed to have seats at the table were people who had budget and authority and the will to act. And the second they quibbled or stepped back or said, well, I got to ask a boss or something like that, they were invited to sit on the back row. the people sitting at those seats changed as the process went by, as we recruited new people who had the power and authority to do the next thing we needed to do. So as part of this flow is learning about who you need on the team in order to get to the next step. Part of your customer discovery is also learning about who you need to recruit. Is part of the people who will help you move. And it's going to be different over time. You just have to recognize that.
Right. And this is one of the things that Steve Lang talks about, which is that the team that executes and the team that searches often are different teams. Steve, do you have any thoughts on that? Not just the teams, but the process of going from
it
search
keeps
to
coming
execution.
back to, you know, whether Steve Blank or others are saying is that you have an idea of what people want to buy. That's what you start with. You have an idea of what people want to buy. And how do you validate that either you're right or you're hallucinating, as Steve would say? Okay? And if you're hallucinating, then is it an easy hallucination to fix or a hard hallucination to fix? Like, I can't do that from here because, and that's what the left side is about. It's searching. It's searching for people, and I call it who think of you when they hear what you're thinking about a little bit, you're water in the desert, right? You're water in the desert, you know, because you're a nascent company, right? You just want to say, hey, if, you know, I have this kind of idea, and they just like almost grabbing it out of your hands, as Steve would say. And why? Because you've kind of resonated in your customer discovery with something they value so much that they don't care how ugly it is, right? I mean, we all use Craigslist, or a lot of us use Craigslist. You know, they haven't changed the UI in 20 years, okay? Why? Yet it's unbelievably painful to use. Yet it serves a purpose when you have a certain search that you need to do and you need to find something. You don't care that Craigslist has not bothered to change its UI in 20 years, maybe even more, probably almost 30 years now. And so customer discovery is trying to find that mix of things. You know, who's your customer? Why do they want to buy it? What value do they create from it? What's their willingness to pay? All those sort of things, the right side of that business model canvas. The mission, if it's a mission-driven thing, like I do in ocean stuff, is it, you know, ocean health, is the world going to be better? You know, whatever way people judge things. And once you get that, then you can feel pretty confident that, given that, how many of you are engineers or engineering driven? Right. So all of you think you can build one. And so you just got to find out what to build. And sometimes it's subtly different. It needs to run on, you know, on a different kind of power source. And other times it's a complete redesign. Okay. But you need to find that desirability. And when you're looking for desirability, and the reason for that desirability, you have to realize you're looking for the crazy, the person who's taking a risk with you. Okay. And that's really hard. You can always, you know, we always talk about, you go to a meeting, you see the customer, you've decided that you really do have a good idea. They show it, you show it to them, and they say, come back when you're in the beta, or come back when you're customer 5, right? Whatever it is, they just told you go away. It's a kind way of saying go away. So never when you get out of a meeting, the customer said they'll want to see it when it's TRL 9, but they don't want to see it at TRL 7, okay? You're looking for the TRL 7 people, and that's the discovery that you're really looking for, not only reason why, and then you can decide that that market is too small, you know, like I'm, you know, making something for, you know, geo satellites, and I don't want to sell to the big guys. You know, it's going to be a pretty tiny market. You know, how many people can afford to put a geo satellite up? And so once you have that discovery search, you go, I think I got it. I think I got it. And then you go into execution phase. And this is the phase that is easier. You can hire people pretty straightforwardly for, but rarely somebody who is a idea factory discovery person is the same person who's the execution. The person who's going to build the factory that's 1,000 people working in some way is different than the person who's tinkering in the lab or tinkering with the ideas.
Thanks so much. What have you seen instances where like basically a company honestly still needs to do discovery once they've scaled a factory execution team? How should they think about going through that?
It's really hard.
Yeah.
You know, you see companies all the time. This is, you know, I would even defer to Chris on this one. It is really hard. Think about it. When you grow a company up, you start hiring people who think in efficiency and time to market and zero defect and secure enclaves and, you know, all of these things. You know, how many people have a CIO in their company or work with a CIO? Not to anybody a CIO in this company before I disparage them? CIOs don't like any changes to their networks, right? Inherently, they don't want to change the network. You come in with a new idea. I want to bring this device I just saw. They go, oh, you got to go through 1,000 steps. Well, almost all organizations, when they get into execution mode, optimize for execution and therefore diminish the search team. It's like why a lot of people get thrown out of companies. They, you know, you're the annoying person. You go from the annoying person to the, we need to get rid of them. Okay, and that's what happens to all the search people. The annoying people, I have to get rid of them.
So what
you
is,
as a CEO have to figure it out.
So what is the milestone that takes you from search to execution? Peter, Steve, like what is the milestone that takes you from search to execution? How do you know that at this point you're no longer searching for something, you found it, now you need to go and start executing, operationalizing, scaling the thing?
I will tell you it's murky, and it has to be discovered in a process. Now, here's where understanding what I call the cycle speed of the tech versus the problem. The slower the cycle speed is, the more likely you can get to the execution mode and stay in execution mode. But if the tech is hitting the battlefield or hitting the consumer market and it's being adapted by the users at a fairly rapid pace, and you get wedded to scale that takes too long and is too heavily burdened, somebody's going to disrupt you because they're going to build something that's better than you faster. And you really have to understand the timing of technology adaptation in the product market and how consumers will use something versus what it takes to actually scale it and deliver it in terms of time. And this is a perfect case of where you pick the right partners.
Yeah, and this touches on Clay Christensen's innovator's dilemma, where once you found something, you want to stick to that product, and then eventually somebody who's smaller and more nimble is iterating on something totally different that puts you out of market eventually. So how should companies, once they've reached execution, continue thinking about innovation, R&D, to stay relevant in the market, not just now, 2 years from now, but 10 years?
I relay a conversation I had with a micro robotics company at one point in the middle of say 2012, and we were trying to get massive amounts of small robots onto the battlefield that we could do something. And my team had looked at this company 6 months, 8 months before, gave them a bunch of feedback and discounted it. And the company had a line of business in law enforcement, and to their credit, they took the feedback that those guys gave them and went back and rebuilt a lot of parts and pieces on this thing, and they started selling it to law enforcement. And then along another problem came, and I went back out and talked to people and talked to my folks, and I saw this thing, and they said, well, no, we looked at it, it's useless. So they go back and look at it again. We bought, I want to say 3,000 of the things and sent it to Afghanistan, and they were working, and the company was high-fiving themselves, and there was all kind of press, and they sent the congressman to they're pumping things up, and the guy said, this is going to be a program in America, it's going to be $1 billion thing. And I said, no, it's not. This is a short-term temporary fix to a problem that's going to continue to evolve. If they continue to evolve their product and keep up with the problem, they'll be $1 billion company. If they don't, they're going to be zero. It's not about the product oftentimes, it's about how people use the product and how fast they adapt things over time.
I'll ask one more question.
Let me just, yeah. So another way to think about it is companies are product lines, not a single product, right? So you're going to have a product line strategy. The second thing is the CEO has to value change. If the CEO gets in execution mode, then the whole company goes into execution mode. So it really comes for me from the CEO. How much is the CEO open to change? You know, how much are they doing customer discovery? How much are they themselves coming back with new ideas, okay, and from what they're finding and working with their team? If that starts dying and you all get in execution mode, that all of a sudden those people start leaving, okay, and they'll leave, you know? How many of you been in a room where you go, that person's annoying? Okay. Frequently, they're the change agents. Well, good. All right, we're not doing that deal. That's off.
So, I don't know why you just talked about me that way. I totally kid. That was a joke, obviously. One of the things that I wanted you say all the time, Pete, is remind me of the phrase, but it's common language, common operating picture, and it just stuck with me previously. But when you use the word discovery, right? Just for everybody in the room and online, what does discovery mean? How is it different than early sales? What are the principles of good discovery?
Yeah, I would say good discovery is driven by nothing more than scientific theory. It's the same way. You create a series of hypotheses, and you create a series of models to describe what the hypothesis is, and then you go out and talk to people to validate or invalidate the hypothesis. And through that gathering of data and validating and invalidating things, you learn what the truth is versus what the not truth is. Here's the mistake people get caught up is they feel like they need to validate every hypothesis. My hypothesis was correct. And when I see a team come in and say, we were correct, I look at them and say, either your data sucks or you're not stretching hard enough to really understand the truth. This whole theory about fail and fail fast comes from creating a hypothesis and failing at it. You can't convince me that you understand what right is until you understand what wrong is and why wrong is wrong. So this process of customer discovery is really, while people say it's a lot of social science, a lot of other things, it's not. It is scientific methodology. Create a hypothesis, create an MVP or a model to test the hypothesis, and go gather the data that tells you it's right, it's wrong, needs to be modified or something else, and do that relentlessly. It doesn't stop with product stuff. It actually continues with, how do I finance this? How do I deliver it? How's it going to be used? It doesn't ever stop. But it is a discipline that has to be learned. The second one is you need to learn how to talk to people. And this is the hardest thing for a lot of people, particularly engineers. They know how to talk, and they don't know how to listen. But the goal is only to talk enough to get somebody to talk to you. Interviewing techniques of, for instance, if I'm talking to somebody doing something, I don't take notes. I have somebody who's not engaged in the conversation keeping up with me. I also understand the things that I'm supposed to ask, and if I forget to ask one of those, I get an elbow that says, you forgot to ask about this. So interviewing and doing customer discovery is not necessarily an individual sport. It really is a team sport. Sometimes it's divide and conquer because I got to talk to a lot of people. But it really takes some thoughtful organization before you go into the room with somebody. You have a finite amount of time. And quite frankly, you have 30 seconds to lose or keep the person you're talking to before they quit listening to you. If they're engaged and they're feeding back, you're getting rich context and it's really working for you. But interviewing people is really is a skill that has to be practiced and put together for teams.
How many people have a hard time getting people to respond to their cold emails? Okay? That's a skill. And I'm just going to, there are a lot of people who have written about it. It's something you should think about. It's your email. Okay? How many start your emails? It's the classic one. Hope you're doing well. Anybody do that at the beginning of their emails? Well, good. That's the first thing you know. All right. I used to do that, but it's a terrible thing to do. You need to do your research and figure out and have a competitive reason. Why should they waste time to talking to you? okay? Because, they get called every day. I bet you, unlike me, who's a venture capitalist, who, I'm happy anybody who wants to talk to me because I'm looking for investments. A lot of people have other things on their mind. So just think about, there are ways to make an email. You want to, a fellow graduate of a college, oh, I might want to talk to somebody who went to my college. A sports nut, I saw that, on your Instagram. I do a lot of sleuthing to understand, to connect with that person so they'll respond. I will tell you, you can go from a hit rate of very low percentage to a much higher if you really think why that person would want to respond to your email and what's in it, not just what's in it for them transactionally, just they might just enjoy it. And this is something in the customer discovery process that people run against the first barrier. I can't even get the meeting. They get the meeting, and to Pete's point, they aren't really prepared with how they're going to run the discussion. And then in the end, you haven't figured out what you took away from that meeting, right? So that the next time you go, oh, I didn't learn enough.
You really have to be careful about engagements, and I haven't done this with anybody for a long time, but sending the right message to the wrong person is a waste of your time. Sending the wrong message to the right person is a waste of your future, because you've just lost the right person. You really have to be careful when you reach out to people, that you understand why they would want to open the email or the message or even talk to you, and then figure out what it is you got to do to get them to actually give you the time.
Yes, Donna.
No, we have a question from online, the representatives for the online attendees that we have here. So this question comes from Lunar Station Corp. I guess on the topic of kind of how to cold reach people and all of that, they're curious and they're asking specifically Pete, but I think we can open it up to Steve too. The question is, how did startups find Pete when he was behind the DoD wall, or how did Pete find them?
How do people get it? When you were at Rep, how would they get in touch with you? How would they find you that you would respond to an email?
Yeah, and I will tell you, Rep was a bit of a different animal. We did a great job of getting in front of large groups with a list of things that we were interested in. And I built networks of people so I could go ahead, we call it the RIPPLE, the Ref Integrated Priority List. Top 10 things that I was interested in. Quite frankly, I would tell people, if you want to talk about the top 3, I'm happy to talk to you. If you want number 4, 5, and 6, it's these guys on the wall back here. And it was a little bit of a discipline, because I was basically telling people, I don't care what you do, you got the coolest stuff in the world. I only want to talk about these things. And if you have something else, I'm sorry, I just don't have the time to spend with you. It's not too bad, but I just don't have time. What I loved most is I could go to a lab someplace, and I'm really familiar with Boston Dynamic or SRI or some of those places. And after I got past all the BD people and the vice presidents or somebody, and actually got to talk to the researchers, we had the most fascinating conversation, because Boston Dynamic is a great example. I went there about, the commercial with the human bot that does everything. I saw it when it was supposed to be testing chemical suits. That's what it was built to do. And they went in there and they showed me this thing, and it was amazing. And we're talking about bots on the battlefield, and I walked away, and there was a robotic snake crawling up the wall. And on the bench in front of this guy was this thing that looked like a cockroach. And then over here, there was a notebook with wheels with a piston in the back that looked like it jumped over things. And by the time I was done talking to that thing, I had a project called Fleabot. One of the challenges I had in Afghanistan is the walls. And we had to be able to look over. The only way to go see what's on the other side of the wall was either blow the wall down, or have some guy on a ladder, crawl up and look over, at which point he gets shot, or somehow throw something over it. So we had these throwable robots. You throw it over the wall, guess what? Some dude's got to go get it. So having something that would jump over a wall was fascinating. Bought 4 or 5 of them. We always had these drainage pipes and things like that had to be cleared. And robots, because they were rocks and they were muddy and they were crappy, we just couldn't figure out how to do it. Along comes Rex. You can actually, R-H-E-X, I think it's over on Google. Rex is a robot that, regardless whether the right side down or upside down, forward or backward, crawl through these damn sewer pipes. All of that got developed because I had a sense for the battlefield, and I could talk to a technologist about the right side or wrong side of doing something. So it was less about people getting to me than me getting past the phalanx of people to talk to the technologist. And I can talk to my nobody from AeroVironment here. Years ago, I was looking for something that looked like a quadcopter. And AeroVironment, had all the Army's contracts for flying things. And I just happened to be in LA at the factory, and we got past the flying parrot that flew around the office. And I said, that's fascinating, but not going to work. But they say, hey, we're demoing this quadcopter. And we went out and watched the demo, and they flew it around. And I said, I could buy 1,000 of these things right now. And there are two guys in front of me. One was the engineer developing, and one was the business development guy. And yes, no. The engineer said, yes, we can do it. And the BD guy said, no. It turns out that AeroVironment made a decision not to get in the quad business. They stick to fixed wing things out because that was their supply line, and that's what their factories were built to do. Guess who built quadcopters? DJI. And they cornered the commercial market, and years later, here we are. And the U.S. is still trying to get there. I know I didn't answer the question directly, but this is from a government guy. I got to get past the VP for development, sales, whatever. I want to talk to the people who really know what they're doing, who understand and can have a dialogue about the problem.
So I think what Pete brought up is when you're trying to get in touch with one person, you're really trying to get in touch with 500 people. And you just can't choose, oh, I didn't get this person. How many, who had that job before them? Who works for that person? Who other companies that have a contract with that person behind the government? Can I get to know them so that they'll do a warm intro for me? There, you go through multiple techniques to find it, and you should be thinking that, oh, I need to get the head of, well, certain people like DARPA PMs kind of want to talk to you, but others, they say it's somebody who doesn't, you just want to do a circle around them and crack it. It's hard. I mean, to the person online, it's a hard problem, but frequently people just try to go one way through the door. And you really have to go like as many as you can. You go to a conference where they might be, and pigeonhole them there. There are just a lot of different ways you can get to people.
The people that you have doing that for your company have to be smart. One is they have to be able to talk to other people. They have to understand the technology inside and out, and they need to understand the problems that technology solves. And they have to be smart enough to listen to potential customers and other people to get them to talk, and then to actually engage in the dialogue. If all they can do is talk technology and they don't understand the other two, it's going to be a short conversation. If all they can talk is BD and sales and other things, it's going to be a short conversation. So the person leading this, particularly for a small company, has to be a generalist at everything. They need to know the guts of the company and the technology and what it can do and competitors and everything.
We have time for one more question.
Thank you for the presentation. I kind of curious. I mean, if we think about the discipline that was required to do customer discovery and do it seriously and then see it all the way through, it takes a lot from people and it takes a lot of energy out of it. And I find as you sort of hire more people in, the company grows. The founders probably have developed that discipline, see the value in it, but the new employees come in and they may not fully have been converted, let's say, to the benefits of doing the search work. And there is a trend, it feels like, to move towards that execution realm where they want to put away from doing that. So I'm kind of curious, how do you recommend keeping people engaged in the fact that we are still in search mode continuously as a company to kind of expand markets to other pieces while there is value in some of them being executors, but it does feel like there is a pull towards people wanting to have stability and security through execution versus being in a more amorphous search.
Yeah, I mean, not everybody's job needs to be in search mode, right? I mean, you get to, but there are people there. Anybody who touches your customer needs to be a sensor, right? Anybody who is in product development needs to have a part of their job is to report on, you normally do it on the competitor. You normally do it on other things, you need to report. And so you as the leader has to make it that you get rewarded for doing customer discovery, all right? Now, it will get squeezed out when you get a GM under you or a divisional somebody because you forget that they are just thinking, that you've made them think product, and sales and revenue and margin and, all those sort of things. So if it's not part of the culture, it will go away. And it's really easy to make it go away. And so for me, it's like telling people like, hey, what have you learned about your customer in the last N period of time? What have you learned about the competitive landscape or new technologies in the period of time? If that's not part of the report up somehow, then it gets lost, right? It's very easy as a CEO, when organizations that I've run, is if you forget to ask the question, it starts disappearing if you're the only one who cares. But it's very easy to jerk an organization around by saying, how is X doing? I work with many of the Hollywood studios for years, and the way I got them to adopt technologies that we were building for the industry, like HDR, which is I would have the CEO or the chairman of Warner Brothers ask their CTO, are we ever going to adopt a high dynamic range technology? That's the only question, because he was on my board, he would ask. And it would just filter down. And all of a sudden, somebody's calling up and going, hey, we got to make progress on this. And so it starts from the top.
Do you have any final thoughts?
Sounds great. Well, Pete and Steve, thank you very much for your insights. I really mean that. It was a wonderful conversation, and I learned a lot. And our pleasure. So round of applause for Pete and Steve.
Okay, thank you, Pete and Steve. And next up, we have another short break, so a little bio break to freshen up, and we'll be coming back in 10 minutes. At 4, we're going to start company pitch presentations. We're going to hear from Otis Aviation, Transient Plaza Systems, and Q Swami. So see you all in 10 minutes. Thank you.
working. Do you want to?
Hello, thank you so much for joining the Founder Investor Panel. We're going to be talking about venture to markets today, and we have a lovely panel here out with us, and you all are very familiar with Anushka, who was the one giving the bootcamp session earlier today, but this is going to be our last session for today. Very excited to have such a wonderful panel to round out our day, but without further ado, Anushka.
Thank you. Thank you all for, it's late in the day and I'm sure everybody is tired and wants to get to the drinks. So hopefully we can keep this interesting. So today we're actually continuing on our conversation about exits, and we've got a wonderful panel for you that have a wide range of perspective on this. I know we talked about this earlier, so hoping to go deeper this time and, get your further questions, et cetera, on this. So today we have Riley Reitz over there, CEO and co-founder of Iris. Sorry, just forgive me. It's been a long day. CEO and co-founder of Iris Composites. Iris is developing a patented software, materials, and high-volume production platform for creating continuous fiber reinforced thermoplastic composite structures. That was a lot of the mouthful. Basically, but the market reach includes portable electronics, footwear, bicycles, automotive, aerospace, everything, you name it. So really revolutionizing manufacturing. We have Henry Deshays, partner at New Fund, an early-stage VC firm that's active in the US and Europe. Kevin Nortiger, am I pronouncing that correct? Okay, almost there. CEO and co-founder of Ampere, the first ever hybrid electric aircraft, which is in market with over 30,000 miles in flight. And Chris Moran, who you are familiar with already, who has been talking to us all day, who leads Lockheed Martin Ventures. Thank you guys for joining us. Just to maybe, we've talked a lot about exits today, and I think maybe just to really reiterate this, when should a startup, given that we have 2 startup founders and 2 investors, really start to think about exit strategy? What is the right timing for that? And maybe we can start with you, Kevin.
Well, I think so Kevin Nordker, co-founder and CEO of Ampere, we're 8.5 years in. Not that you should be aiming at an exit at the very beginning of your company, but an exit, I think, is a logical conclusion of a good, well-executed business. Whether that's a commercial revenue generating so you could succeed in the public markets, that narrow sliver, or you've built yourself to be useful in the industry so you get acquired, or maybe your exit strategy is truly just a cash flow. This is about creating a great business. And I think that from the very first days of your company, you should be looking at your business model, technology, value proposition, and that flows into exit scenarios, but ultimately I would say, leave the options open and don't try to tailor it too much specific to an exit. Make sure you've got the business fundamentals down first.
Yeah, so maybe just to add to that too. So we've been at it. You got like 1 year ahead of us. We've been at it about 7.5 years. And if you're a startup founder, you're in the Bay Area, you took VC capital, you're going for IPO, right? And anything less is something that you're settling for. And that's certainly expectation when you start to take those capital dollars from this community. And so the initial plan is always, okay, how do we make this $1 billion plus business? But then realistically, along the way, and pretty early on, you need to start looking at who your customers might be and which customers could be acquisition targets, right? And those things, I think, those things are something important that take a lot of time. Like if someone's going to acquire your business, it's not going to happen, or it won't happen, let's say, in a pretty way through a fire sale. So I have seen issues before. Even in my last company, after I left, that went through that sort of kind of fire sale. And once you're like shopping in business, it's bad news. No one's going to win. So in order not to get into that position, you need to start identifying pretty early on in the journey who might be the soft landing, companies that could pick you up.
And potentially also avoiding some actions that may prevent or may make an exit harder in the future. Taking strategic investors very early on.
I am so tired of hearing this. That is such BS. Why? Look, 30% of all venture deals have a strategic investor involved today. Why would anyone say that? That is just such BS. I hear that so many times. look, you are assuming that I'm going to buy that company. What if I behave just like you?
Oh, how you behave?
Yeah.
It
What
may
if I
not be as
behave
important.
just like you, just like a venture capitalist? Wow, which is what I am. Why wouldn't you
So-
want me on there? I could be that company's biggest customer. I had this exact situation earlier last year. The company came to me after the third. We've been dogging this company for a year. We want to invest in you. We want to invest in you. We could be your biggest customer. We want to. Oh no, our other investors. This guy said, "Don't take their money. Don't take their money." Now he's come back. Now the C round. He's worth $700 million. I said, "I can't invest in you. Have fun. Try to figure out Lockheed Martin. I got the decoder key to Lockheed Martin. I know everybody in there. So have fun. Fight it yourself." So you got to understand that strategic investors have changed from whatever bathroom wall you saw that written on somewhere. Please scratch it off, because we are not that way anymore. If you want to, and you found my hot button, believe it or not. Could you tell? That is my
I
hot
feel I
button.
have.
It's just ridiculous.
Just
That
told
is
a sugar
that
manufacturer
carte
to not eat
blanche
sugar.
Statement. Wipe it from your head. Talk to them. I think you heard earlier in the discussion. Find out why I'm investing in you. Right? Make sure my strategy is aligned with your strategy, and everything will go great. But take that thought out of your head. That is not the way the world works today. Corporates are very, very involved in this business, and a lot of money. A third, the report, I just talked to Silicon Valley Bank yesterday. It's a third of all venture dollars come from corporates today. So, sorry.
But let's continue on that topic. There will be a point where you will have strategic investors. If you take the strategic investor very, very early, and if you take one strategic investor, it will be perceived, however how nice and well-intended that investor can be, as the fact that you are in bed with one corporation. And go and try to, maybe.
I'm probably a 2% shareholder. Who cares at that point, right? I'm 2 to 5%. If I'm 30% or you're right. But I'm not.
Yeah.
Generally, we're not. We're
And
very
how you will take that money, for example? Is there an investor at the board? Does he have 20%? Is there a right to block the next round? Not everybody is as nice as Lockheed.
No, but that's part of that's part of you guys' responsibility to look at that. What costs am I asking for the money? What things am I looking for? And generally, I would say there are corporate investors that do exactly what you said, and I wouldn't take their money unless you see them as your exit path or as maybe your largest customer ever to do that. But if they're investing like everyone else, which we should in the early stages, no reason to limit your opportunities, limit your exit, or limit your markets. And if money's being offered to you without those stipulations, just we're the same as everyone else. But if it's coming with a bunch of strings attached, I totally agree with you. Right? Sorry.
I guess just to follow on from that, Kevin, Riley, what are your thoughts on strategic investors and exits?
Yeah.
What's been your experience?
So I probably started out more in your camp, but especially through this company with Eris, I'm in Chris's court, and I think a lot of people were in that mindset. But no, they've changed. If you want to be on the cap table, if you want to be part of deals, you don't put these crazy blocking terms and other stuff. I do think that's pretty archaic. And while you may find it, I would say it's not as common now. So we have Bosch on our cap table. We have Zebra, a big consumer electronics brand. We have like ST Engineering and aerospace, right? And they don't have control of the company. They're limited even in some aspects in terms of what we do with other companies, and they're fine with that, right? And so the benefit was we want to work with these companies. We want them to be our customers, and having access from an investment side creates a skin in the game. It's not just, hey, we're going to look at evaluating your tech and we'll get to it when we get to it, but hey, let's actually see how this could work. And you get a little bit of energy, and sometimes that's all you need to really prove out an application. So yeah, I'm very, pro strategic investors. It's helped us a lot.
Yeah, and I agree. If you're doing it right, if you're making sure to not take the bad terms, or if you have to be willing to walk away from a bad deal, and that's hard. But if you are able to stay to those good core principles, then there's a lot of value that can come out of the strategics. In our industry, it's important from a fact that most Silicon Valley or other investors don't have the technical wherewithal to really do thorough diligence on companies. You hear a lot of fantastical stories about what things might look like, but what's real, and how do you validate that? These are questions that VCs on their own sometimes struggle with. And so having strategics come in and do that diligence, validate both maybe the technology side, the market side, even kind of the economics of how that all plays out beyond what the venture capital firm would normally do, brings a sense of comfort there. And then, of course, from a strategic, either in your supply chain or in their supply chain, there's a lot of value that can come from having really close relationships. You don't have to take money to build close relationships, but it is one mechanism by which you align, at least in part, your destinies.
Just to follow on onto one of the points you made about how the diligence that they do is different than the diligence from financial VCs. Like in this last round that we closed, we got a number of financial VCs we would not have gotten had, in this case, ST Engineering invested. Because they couldn't themselves assess, is there an opportunity in aerospace? They can see what ST generally invests in. So there's a vote of confidence, even if there's not a product in the market out. They can bring financial VC, so it can actually, let's say, play the opposite effect. Having the right strategic can get you a lot more capital than you could get without that strategic. And I'd say that's even more so in this market. Generally, it's still not a great time to go IPO. Later stage rounds are still very challenging, and VCs are a lot more hesitant about what they take on, and certainly what valuation as your company gets older. And so from advice I was given and what I've seen play out in this last round was that having those strategics on give comfort to the financial VCs, because they start to see, okay, there's cash flow that can come from opportunities you're developing with this company, and they're gonna buy a ticket basically to see what this looks like.
Yeah.
Oh, that's actually a really useful insight that we haven't heard today, and so thank you for that. Following on a little bit, I mentioned earlier that cap tables can have an impact on your eventual exit. Do you all have any thoughts on mistakes that founders can make in their cap tables that make the exit much harder? This is looking.
Specifically, why? I mean, cap tables with hundreds of names on it is always difficult, with different rights of different classes of shares that are hard to unwind, and different priorities and preferences on each of those classes, and just messy, right? Because you can't. It's very hard to figure out what every investor is looking at the value of their investment. How am I going to make money on this investment? And if it looks like all the capital is going to be distributed before you pay me back, it's going to be very hard for me to convince my peers, my partners, whatever, my investment committee in my case, to make this investment. Because it's just hard to figure out how we're going to make money. And the cap table has a big impact on the exit value to the investors, depending on whether it's IPO or M&A, right? Everything kind of flips and changes a lot with that. And I know, like you said, we're Silicon Valley, everyone wants IPO, but we talked earlier today, it's a fraction of 1%, probably a fraction of 1% of the companies that actually make it. So something like 90% of the companies go M&A, an M&A deal, right? And so that's really what you're going to look at in an M&A deal. The cap table becomes super, super important to how people are going to get paid out on it. And if it's very messy and a bunch of stuff on it, it becomes a lot harder to deconstruct.
And also the rights that each investors are going to have depending on when they have invested. If you exit at $500 million, I invested at the seed stage, maybe at 10 million cap, I'm ecstatic. The investor who just invested $1 billion during the crazy 2021 years, if he can, he's going to block the deal, whether it's an IPO or an M&A. Being able at every round to renegotiate the rights and make sure that they are not major blockers for some strategic moves.
I think this comes into one of the dynamics we saw referencing 2021. There are a lot of companies that raised at absurd valuations because the money was easy. And a lot of those companies ended up in very tough times because they overextended themselves, they spent too much too quickly, the market is certainly not the way it was 3 years ago, and they positioned themselves because of those decisions that they made. And this is kind of adjacent to cap table considerations. But if you get yourself underwater, it's going to be very difficult to look at either subsequent rounds or M&A or exits that everybody can be happy about, especially as a founder when you're at the bottom of the barrel. So the I think the risk that you have to manage is just making sure, again, on good foundations and principles, not just eye-watering valuations. Let's say that the cycle comes back and you're offered unreasonably high terms. Maybe it's nice, but just think about the repercussions that can bring and try to always have balance where in a reasonable outcome, everybody would be on the winning side of it.
Yeah, I mean, I'd say, try to keep the lick profit one and pari passu for all the terms. So like if it's clean with investors from A to B to C to D generally are receiving overall the same terms and getting the money back in kind of an equal distribution to their percentage, it's so much cleaner. And so people looking at the deal will say, okay, I see where the money's going. It's easy to track. Things can get complicated real quick, especially in like the downturn or down round type of situations.
So timing, you mentioned 2021 a few times. We are in 2024, a very different time. How much does timing affect the ability to exit? And I guess, what do you think, what kind of time are we in right now?
I used to, when people said good luck, I would say no thank you, I'll just work hard. I welcome the good luck now. I think luck and timing, unfortunately, have a huge effect. And you need to fold this into your strategy on how you execute. You don't have everything within your control. And timing and external factors are absolutely going to drive how your organization evolves over time. And so, for example, the first time we thought about an exit was in late 2019. We were about 3.5 years old, coming on 4. We signed the documents right around when we were 4 years old, looking at rolling up at eye-watering valuations to go public via SPAC. And a year later, pulled out of that deal because we saw what it really was, which was not the path that we wanted to take. But there are moments where opportunities pop up, and you have to thoughtfully evaluate those. And those moments might never return. And you have to be okay if you say no to something to not regret that decision, just to learn from it. This particular moment in time it's a tougher time for a lot of companies. I mean, in the last 18 months, we've acquired 2 other startups because of the challenging times we were in and the strategic needs that we had and the strategic positions they were in. And so everybody was able to walk away happy from those acquisitions. We were able to progress in our DoD work by acquiring those and novating over those contracts. They were able to get a softer landing than they were looking at. So that's all about timing, but it's not a single company's timing. It is actually an ecosystem timing and the timing of the various players.
I like playing with numbers in my spare time, so I was just looking at the acquisition and IPO tallies for the last 10 years, and we're down like 70%, quantity-wise from the peak, which was, believe it or not 21. It was a little earlier than that. It was like 2016, 2017. And, a lot of things conspired for that to happen, the higher interest rates that came through. As we're finally seeing a little relief on that, maybe we'll see a little hope in there. And then the current environment for acquisitions for company acquirers is not great. I mean, you see a lot of lawsuits going back and forth, a lot of deals being stopped, so people are a little gun shy. So it's not happening. So the exit market is kind of tamped down, and then you see that flow through. Like I said, I was talking to Silicon Valley Bank yesterday. Inflows to VC funds is way down, right? There are very few funds getting created right now, new companies raising smaller rounds and smaller funds overall. It's not a great environment, but there's light at the end of the tunnel, right? If the Fed, continues to crank back interest rates, private equity will come back in the game, and hopefully it won't be great to put your money in your CD anymore, and you'll give it to these guys for their venture funds, and they'll start investing in more companies. But you're right, timing right now is not a great time for this to happen.
Yeah, I mean, I'll just echo. I think luck is a huge factor, and it's always underestimated, right? There's a big revisionist kind of history to all the successful startups, and you don't get down the paths of what happened if that didn't happen. I mean, even like Tesla's like a great example. Obviously, like Elon's work ethic is crazy, right? And he's kind of willed things to happen that you'd be like no one else could have made happen. But even there, Like he stumbled into NewMe, this large Toyota plant, really early on with very little money, bought it for like tens of millions of dollars. It was $1 billion factory. They were selling it for pennies on the dollar. And if that like single event hadn't happened, Tesla would have gone nowhere. He needed that to happen. And so I just think like timing of the markets, certainly as you were just describing, as well as, you know, luck happening both with the timing of your markets and what you do and who you meet and when you meet them, right? And so this kind of plays into the chemistry that people talk about in Silicon Valley. It's like, why do people like to invest here? Or is there something, there's nothing kind of magical about it, but there's a lot of like-minded people just because of the momentum of a lot of startups being here and a lot of capital here. You never know who you're going to meet. You go to these type of events or you go to other things, and it's kind of crazy how that ends up playing into, you know, your company and where things head.
And maybe to tie it up with something Kevin said at the beginning, you can create your own luck. There's a macro environment that you can't control, but most of the acquisitions you're going to hear about, it's not like, okay, we hired a banker and he started, you know, like reaching out to company and we got the best offer. There were companies that were already interested into making an acquisition that triggered that process. And so the more partnerships you can have, you know, with strategics, the more you can explain to your industry what you are doing and why you're important. Eventually, that will create the terrain afterwards for those type of acquisitions when you feel the time is right.
Kevin, you mentioned that you completed 2 acquisitions. So actually, that's a perspective that we haven't heard as somebody being a part of the acquiring company. What worked? What did the startups that you acquired do really well, and what could they have done better?
In their operation or during the acquisition
During the
process?
acquisition process, what made it easy or good or, you know, helped in the process versus what did not?
Well, I'm a pretty like transparent leader and business person, so I think authentic conversations about the situation and transparency about motivations, what each group is looking for, what are the kind of the showstoppers on either side, and understanding that playing field. What went very well for us, both on their side and ours, is that we had established relationships. We had known them for years. And so we were able to jump on a call when we heard that they might be interested in selling and say, like, what's up? Like, what's going on? And there was no varnish. There was no pretense of having to look great on either side. We were just able to talk about the situation at hand and evaluate whether there was something we could do that made sense. And that works really well if you're able to do it. Because if you're hiding behind some smoke screen, I can't imagine the mental dissonance that you would feel going through these types of processes. And I know that there are some strategies where maybe you do hold your cards a little bit tighter. But in these particular ones, what worked very well is it was collaborative. I mean, we held firm on the things that we believed were critical for us to move forward with the deals, and then we communicated well, and that ultimately, I think, led to transactions where you know, no one, I believe, regrets the deals that were done.
Thank you. So we're dealing with, you know, defense startups. Everybody here works with the Navy. How do export controls and regulations that, you know, are very specific to the companies sitting here, how do they impact growth and, you know, potentially exits?
So I'll only say I worked at Northrop Grumman for 7 years in stealth technology and then space systems. Before starting Ampere, I knew the DoD and kind of the defense industry quite well. And so I stayed away from it for 6 years of building Ampere, and purposefully so. I needed technology that was not going to be export controlled, and I needed to reduce the risk of ITAR constraints on our systems and IP. This is important because from a commercial standpoint, we do hybrid electric aviation propulsion systems to upgrade everything that flies. That is a massive market and a very international opportunity, and I could not get locked into what I knew from Northrop was a niche industry that would not realize the full potential of our technology. So that was 6 years, and then 2023 happened, and I said, oh crap, I need to go fast in with the Air Force. How do I get there? Acquire 2 companies, novate contracts, go from 0 to $3.5 million of contract in about 12 months. right? And then win follow-on contracts off of that momentum. Like, this is all about strategy around, in particular, how do you handle ITAR constraints? How do you build an organization? We also have a kind of a sister organization where we compartmentalize everything that we can't handle as a company. Earlier conversation, there was discussion around, does it make sense to bifurcate? And where we, the core technology company, can sell products into an applications company that will deal with other restrictions, constraints that you might get when working with the DoD in order to keep a cleaner line between the two. So you have to, if you're in this industry, you have to be thinking about it from pretty early, and you also have to be able to change pretty quickly, especially as the geopolitical environment is pretty dynamic.
Okay, so well, you did that intentionally. I was lucky. I didn't avoid it intentionally. Things just moved slower than we'd like, but I got lucky in the sense that because we hadn't actually done significant work in the defense space around development of our technology for particular applications, we were able to take foreign money from Taiwan, from Singapore. Still had to go through this kind of arduous CFIUS process, which relates to international investment. It's not fun. There are no shortcuts there. Legal people make a lot off of that, so I'm sure it'll stay in place for a while. But we didn't have anything. Right? So you have to go through this still, because even if you're not working with the defense, if you've developed something that has a very close tie or application to that, and they get very specific in these controls, then you can't take this money, right? And you can't have any exposure into those markets. And so, like I said, yeah, we got lucky into that, but it's allowed us to continue to operate. So it's very important.
As founders negotiate an exit, merger, and acquisition, I guess, what is the thing, maybe one or two things that they should prioritize to protect their interests?
I mean, I'll kind of repeat what I said before. I think like lick-pref and pari passu terms with investors are super important, right? And so, as a founder, you're trying to protect your interest. And so that depends on the terms you give, and it depends on how much capital you take and in what valuation. So those are, like, let's say, the obvious things I think most of us really know about. But you need to keep reevaluating that as things go. More investors come on, option pools get created, and then you got to start to look at your, what your outcome could be, right? And I think this is also a deterrent to future investment and maybe acquisition. I actually can't comment on that. But if the founders and executive team all of a sudden really don't have that meaningful amount of equity, or there's, again, a down round situation, some investors won't want to come into that, or they will only want to come in if there's almost like a recap where you're creating a much larger option pool to incentivize those individuals. Because, yeah, investors coming in to back companies want to make sure that there's a lot of skin in the game amongst the key executives that need to operate and lead the company through a big change. And if they're not, you're going to get mediocre results. And so, there's something certainly to look at and keep a good pulse on as your company evolves.
During, and I know that you all are still building, but maybe Henry or Chris, what you've seen during the exit process, some things that founders should keep in mind. Obviously, you're across the table. That would really help them protect, or things that tend to get overlooked that are actually fairly important during an exit process.
I can think of two things. One, often when you're going to see a company X got acquired for $400 million, that's true if the earnout is met 100%. If there are no liabilities that the acquirer is going to figure out later on, tax, IP, you name it. So what are the conditions, in order to get that amount, and making sure that you still have the hand, for example, in the case of an earnout, meeting some technical milestones or some revenue milestones. Well, next thing you know, a year later, you're out of the company, someone else is managing it for you. It's likely your earnout is never going to be met. So you have to negotiate also your future within the acquiring company, making sure that if they have a change of heart after 3 months and they let you go, that you have like a double trigger to accelerate, whatever money you were supposed to receive. Because very often, for your company, it may be the end of the journey, but like for the acquirer, it's just something that starts, and they want to make sure that whatever they bought is going to happen. So usually pretty long and tedious negotiation.
So this is kind of the little M&A inside baseball. So one of the things, to your point, is that in a negotiation, the acquirer will sort of let you push the value up. It's nice, right? It's going to make you look good. But then they'll say, well, we're going to pay you 50% of that today, and you're going to earn the rest, right, through growth. And one of the things that you need to know at that point, you're not a venture-backed company anymore. You're owned by this other company, and they need to fund your growth. If you didn't negotiate that, you're screwed. I mean, literally, you're screwed. You have this half of your consideration is now at the mercy of the other company who just bought you. And not that they have ill will or anything, but it's a negotiating tactic. So one of the little things you have to be aware of, if an earnout is there, and if you can't agree on the price, this is how this happens, the acquirer will let you, raise your value up pretty high, and you all can look at comps. You can all look at similar companies to yours and figure out what you're going to be valued on. Are you going to be valued on revenue? Are you going to be valued on revenue growth? Are you going to be valued on profit? And you'll have some idea of what the market will bear. And that honestly, all these corporate dev guys go to the same MBA school and get the same degree, and they're looking at your discounted cash flow and blah blah blah. The math is pretty straightforward, and if there's a big gap between what their calculations say and what you think is there, you're going to create this situation that could lead to a not great outcome for you. So something to consider.
And tying into that, alongside the financial considerations that go into that, and the earnout, and one of the things, so when we were looking at rolling up with a few companies, and one of the other things I prioritized, and it's in the envelope of what is your experience post-acquisition going to look like, whether individually or for your team. I'm very particular about the culture of our team, the mission of our organization, the why behind why we're here. And is so much so that when we were looking at this new co that we were all ultimately going to roll up into, defining the values structure of that organization. When I manage, especially in times of disagreement, I've got this structure that I think the former CEO of JetBlue put together. Values, objectives, strategies, tactics, and controls. And so I went straight to the top of that pyramid and I said, what are our shared values? Because we can agree electrification's great, we're going to implement all these strategies, but if we don't align on core values, then this will not work. And so I went to the top of that. We actually established from kind of the origin of where Ampere was, what the values of this shared organization were going to be. And then there was some structure in allowing me to ensure that some of these things did endure, as well as and get buy-in across the organization. And this was in effect, like, how do you come into a new company and expect to not just get squashed by their culture? Luckily, in that case, we were all small enough that we were able to kind of swing that. And I've heard so many stories of companies getting eaten by bigger companies and losing who they are, and then losing their vision, losing their people, losing their productivity, and losing all value. And so this was one attempt, and though we pulled out of that deal ultimately, I think that piece of it was quite successful in how we approached it, and for good reason.
Actually, going off of that, I guess for entrepreneurs that are working on mission-driven or sustainability-focused startups, how are you thinking about ensuring alignment between your mission and values and your longer-term exit goals?
Build a company that achieves both. And if you're building a company where you get only one, then fix that. I mean, truly, like a lot of people in electrified aviation are talking about, fully electric or hydrogen is phenomenal and gets you all these amazing things, but it does not get you an economic solution. And so at the end of the day, not enough people are going to buy it. You're not going to get to scale, and you're not going to get the economics to work out for you or for your customer. So you have to go a path where you can get good economics for the customer and the sustainability outcomes you're hoping for. Hybrid electric aviation is it. Upgrade your planes to our systems. Save 50% of your fuel. No, truly, like it's like this is the only solution that makes economic sense in sustainable aviation. Not even SAF makes economic sense right now. And so it's not about saying we're a sustainability company and we're just going to like dig ourselves into the ground until we stop getting funded and nobody buys our product, or maybe the government bails us out 10 years from now, or you build a good company with good fundamentals. And I think my strong encouragement to anybody looking at sustainability is don't do it and then ask for favors. Do it so that it's better than what you're competing against in the traditional industry, and then earn your way on through just good business and economics, and also, save the world.
Thank you. I wanted to just, before I open it up to the audience, touch on one thing that Chris mentioned. Valuations between the folks that went to business school and our corp dev teams or on Wall Street versus Silicon Valley valuations. How do startup founders manage that friction between it?
There's different type of acquisitions, right? If we start at the bottom, the first one is acquire. Your startup hasn't worked. Someone believes that whatever was built is interesting. The engineers have potential. That may be like the single-digit number. The second is like you're selling a technology or the promise of a technology. You add a zero to that. The third one is you're selling a business that has promises. This is when the MBA folks come in play and try to do some DCF. The last one, and that's what every VC is trying to bat for, but they're right maybe like 2% of the time, is a company where the incumbents have no other choice but to acquire you. Otherwise, they get an existential threat. The majority of the companies are not going to get there, yet they have raised at the promise of that valuation. So every round that you're going to do is almost like a reset in terms of like where you want to bring the company. And I would argue is also a moment where you can kind of like pause and see like, okay, do I believe I can 10x the valuation that I have today? Or am I at a stage where it may be interesting to think about an exit?
I think it's simple math. Try to create a company that you can value at $2.5 billion, and you raised $50 million to get there, right? And you got such range of what you could sell at. Everyone wins all the time. I mean, that's the magic. So you're exactly right. There are different types of M&As. One party wants to drive the cost down as much. The other one wants to drive it up. We just read in the paper yesterday, Google paid $2.5 billion to hire one guy, right? They bought his entire company. They left the company separate, or they licensed. It was a license agreement. I remember it was a $2.5 billion license agreement with the stipulation that the CEO came to work for Google. Wow. All right. I don't think that's normal, but that's the kind of stuff that goes on. So it's kind of wide open what can happen. But in true M&As, you're either going to be, a valued M&A, an acqui-hire, or a trade sale. And trade sale is like just above asset value. If at asset value, it'll be pennies on the dollar for that. But I know that the corp dev folks, as I said earlier, most of the time that a large company is buying a company, at least in their mind, is for creative value, which in large corporate speak is free cash flow. So if you're not generating cash, then their valuation is going to be pretty low on what you look at.
So the simple answer. So earlier this morning, I was in a diligence call with the group looking at leading our Series B, and it's a toggle switch. What's the WACC that you're using, and are you closer to 8% or are you closer to 30%? So it's like sometimes as easy as, are you a private company valuation or are you a public company valuation? What do these look like given our assumptions on projected cash flows? It's a little bit later stage. I wouldn't recommend doing that for your earliest financial models. But it's kind of then at that point in time, like, look, these valuations, we're raising about 50 and we'll be about $2.5 billion. So at that stage, it's just about like, well, what's like what's the probability that we put and what's the massive discount that we take off of that so that we don't overextend ourselves. Like I said, don't raise it too high of a valuation too early, because then you block out good outcomes along the way.
I want to open it up to the audience. I think we have time for 1 or 2 questions maximum, and then I'll let you all get to drinks. Open to you. And I'll come to you with the mic so that the folks online can hear as well.
Everybody else is getting tired. I want to go back to what you guys were. I enjoyed the beginning of the panel where you guys were fighting and dueling it out. So let's get back to that. And I guess I'm most curious. Is 2 questions here, but kind of similar. Is there an opportunity as a private company to just not disclose who your strategic, venture capital firm is, right? Like your corporate venture, you don't really have to list it anywhere. So like, first of all, is that an opportunity? And the second thing is that sort of related to that, where's the importance on the control piece, right? Like, is there a way of like sort of setting it out? And I mean, I've been through this particular issue where we didn't want to bring on a corporate venture group specifically because of the signal that was sent to the market, but much more willing to do it if they weren't taking lead or taking any sort of controlling stake in this. So like, how to structure that and have that conversation with that group, because, yes, want their money, yes, see the value of them as customer, don't want to send the wrong signal to the market. So
you're sending 2 signals. The first one is actually positive. As Chris mentioned earlier, is like, look, folks that have been in the industry for a long time that matter are interested by what I do and want to partner with me. The signal to avoid is, like, if you are one of their competitors, you cannot work with me anymore. I have seen some companies trying to kind of like put that on the side. Not sure I would recommend it. Like there are like some countries where you can basically like carry shares. There's also like type of warrants. I think it's more around the rights. Usually, so what I tried to say earlier is like it was not don't take any strategic investors. It's like when and how. Very often, it's at the Series B stage, and very often you're going to see more than one strategic coming in, and that shows certain types of balance, and then also negotiating the rights correctly.
You heard me before. I won't get animated again, but a couple things on that. One is we're in national security, right? I'm a national security investor. The nation is first and foremost, so we actually are investing, co-investing with the other primes, right? You can look at number of cap tables where Raytheon and us, or Northrop, or Boeing, or Airbus are in. We're all on the cap table. We're all sort of agreed at this point that this is going to be pre-competitive for the most part. So from the investing standpoint, that works. Now, it does get a little messy when we get to programs and things like that, because I don't want them to see what we're doing. They don't want us to see what they're doing. And then you have to be in the boardroom a little bit more, covered up on things like that. But the other thing, one thing to ask, again, interview your investors. If you're going to have a strategic on the cap table early, make sure they're in not just one time. Make sure, you don't want them just to pollute the pool and then make it look ugly for everyone else. You want to make sure they're there for the next couple rounds at least. And they should have an intention. You could ask them, how much money have you reserved for us, for the long haul? And if they, then maybe you're not the investor I want at this point, right? So I want to look a little bit later. Maybe, to your point, come in at the B round or D round and write a big check and have strategic rights associated with it. So that's the way I would look at it as well. It really comes down to you talking to them about why are you doing this and how are you going to participate.
We are at time. So thank you so much for joining us today. We really appreciate it. This adds a whole level of insights from your experience and expertise. I hope you're joining us for drinks so that folks can talk to you in person and pepper you with other questions. Thank you all. I will let Donna take over from here, but thank you.
Folks, so that is the end of our session. Before you leave today, please, please, please fill out our feedback survey. They're on the backs of the chairs and also on the screen too. So if you just take your camera and scan the QR code, you can take the survey. Another note is please bus all of your dishes and everything. There's going to be a station right outside the door. So if you could take all of your belongings with you, that'd be great. We'll continue to be doing these events, so we hope you join us for the next one. We'll definitely invite you all again. Recording will be made available and slides will also be made available to everybody here. And thank you so much for joining us. Also shout out to the Playground Global team, Gail, Jeff, and everyone else that has been helping us today in the AV station. But thank you so much, and we hope to catch you at the next one. Thank you.